Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall. Here are the three things that you need to know to start off your morning. More weak data out of the world's second biggest economy, creating a headwind for investors this morning. A key reading of China's services sectors showing PMI declining to 53.9 from 57.1 in May. That's the weakest since January and far below forecasts. China's authorities have been looking to boost domestic demand in the aftermath of brutal COVID-induced lockdowns. The Taishan survey is focused on smaller companies, so it provides a different perspective to the official services PMI. And more key data points on the docket this week as well here in the U.S. Friday's payrolls report, that's going to steal the spotlight as the data-dependent Fed looks to more rate hikes in the months to come. Before then, the release of minutes from the central bank's last meeting will be closely watched. The Fed's decision to pause its 15-month-long interest rate hiking campaign was unanimous, and investors will look for any signs of division in the committee. Markets are pricing in an 86% chance that the Fed will raise rates by another quarter point come July. And delivering the goods, Tesla's seemingly unstoppable rally getting a tailwind from strong production and delivery numbers. Total deliveries for the second quarter coming in at 466,140. Total production for the period at just under 480,000. Both of these numbers beating expectations. The EV leader doesn't report official sales numbers, so deliveries are seen as a key proxy, and the company's performance in China could be seen as the big win here. Deliveries from Tesla's Shanghai plant rose almost 20% from a year earlier.
It is our first full market day of the second half of 2023. After a better than expected first half for stocks, the S&P 500 rallying so far year to date up over 16%. The outlook towards the year's end is mixed, with Goldman Sachs the only of the big banks seeing upside for the index to close the year. Their expectation hitting 4,500 in the analyst forecast. Morgan Stanley, the biggest bear among the large banks, has the S&P 500 falling all the way to 3,900 by the end of the year. With more economic data on the horizon, uncertain Fed moves, can stocks continue to rally, or is there downside from here? Joining us now with a deep dive is Yelena Sholetyeva, BNP Paribas U.S. economist, and Brian Levitt, Invesco Global Market Strategist. Brian, I want to start with you, and we'll start with an outlook for the second half of this year. Nasdaq was the clear winner so far. What's your expectation for the back half?
Actually, you're starting to see a little bit of broadening out in terms of market participation. So it was a very defensive, high-quality trade in the spring with only a handful of names driving performance. And so we are enthused that we're starting to see a little bit of broadening out of that. In fact, our indicators are pointing towards a market that's sniffing out a recovery from what had been a weak patch here. Now, that's not necessarily the beginning of the new elongated market cycle, but one that provides a nice tailwind for markets as the market's starting to look at inflation that's coming down pretty rapidly, and a Fed that's got to be near the end of its tightening cycle. That starts to create, at least in the near term, a better risk-on backdrop for equities. Now, look, we still have to deal with what the lagged effects of all this policy tightening is at some point. But I always go back and advise investors that in the couple of years after the peak in inflation, which was last June, and a couple of years after the end of Fed tightening, stocks can do very well and have historically done very well.
You know, Yelena, even as Diane was mentioning, where some of the targets for the largest banks here in the U.S., where they sit as of right now, many of them still in comparison to where we're at right now, they seem still bearish. So what is that Fed risk that still remains at this point?
I think we need to look at the economy and see, just go back to the fundamentals and see where the economy is and what outlook is for the second half of the year, right? We are very, bearish on that front. So we expect economic downturn to start this year in the second half. We're already in the second half, and we are seeing a lot of signs that is already happening. We saw manufacturing SM on Monday. That was really weak on all fronts, employment, production, new orders. So that was a weak indicator. We see some upward movement in jobless claims, so that is a concern. And we see some bankruptcies rising, and we think the decline in corporate profits will be detrimental to companies' plans on expansion, and in turn, that will result in larger layoffs in the second half of the year.
By downturn, are you actually expecting a recession this year?
Yes, we are. We are expecting a recession this year. I know that the data has been, some data has been surprising to the upside, but others are surprising to the downside as well. So look at personal consumption expenditures. We received the report last Friday, and that showed a significant slowdown in consumer spending. So compared to the first quarter of this year, the 2 months of this year only show 0.8% growth in consumer spending in real terms compared to 4.2% in the first quarter. That is a significant slowdown in one of the biggest main engines of the economy. So I think we are actually slowing down pretty fast.
And Brian, I mean, on your side there, you're a little bit more optimistic about where we're at right now. So does that anticipate then a recession that is better than feared? Because if there has been a story or a through line that we've seen from some companies who've reported earnings this year, investors have reacted to the fact that it's been better than feared so far. And so what does that spell out for the type of recession that we might even see?
Yeah, it has been better than investors fear. I mean, this has been the most anticipated recession that you can imagine, and it hasn't happened yet. And the economy is still too strong to be talking about a near-term recession. Now, are you hitting some of those guideposts? Sure. You've got a deeply inverted yield curve, and banks are starting to tighten lending standards. So you'd be naive to think that there's not an economic downturn coming. But the market is not the economy, and that's what is critical here. The market was down 9% last September, getting ahead of what was expected to be a pretty significant economic downturn here. The market was down 25% peak to trough last year. Again, the market leads. Now, if you go back historically and you look at the more mild recessions like in 1981, like in 1991, stocks tend to decline 20, 25% and hit a new high within 1 or 2 years. And that seems to be precisely the path that we're following right now. In fact, this is very reminiscent of the 80-81 environment, which I understand that, you know, I talk about a lot, even though I was only 5 years old, but I did read about it a lot in textbooks. And you know, in 1980, inflation peaked in March. The Fed did raise rates through the end of the year under Paul Volcker. There was a much anticipated recession. It happened. But if you had invested when inflation peaked in March 80, or you had invested when the Fed was done tightening in December 80, you were thrilled by 82, 83, 84. In fact, you were thrilled out to 1999. So I'm not suggesting a 17-year bull market, but this is following a very similar path to what we saw in 80-81.
So, Brian, I got to ask you. So I was also a child then as well. Brad wasn't even a thought in his parents' mind, possibly then. I don't know. I don't remember the exact date. But I want to ask you just a follow-up question about how the market is potentially. Is the market actually pricing the odds of recession right?
Well, I mean, the market did. So when you got down to 3,600 on the S&P, that was a market that, you know, let's just use back of the envelope. You know, that was from a peak earnings decline, call it 20% down to 180. And then what multiple are you going to pay on that? The expectation was as the economy moderates, interest rates start to come down. And we saw multiples bottom at 18. And could they get to 20 in a lower interest rate environment? So 20 times 180 gets you to the 3,600. So to me, that's the bottom. Now, we've had this nice run as things have been more resilient and inflation has come down pretty rapidly. Now, we do have to still think about, well, when do we get to the beginning of this nice new elongated cycle? Right now, what the market is telling us is we're getting a recovery feel here. And, you know, that recovery feel is more of a risk-on type of an environment. Can we is this the beginning of the recovery, then the expansion, the new cycle? That might be overstating it. You likely see some retracement in the early part of 2024 as you start to think about a recession. But my point is to say that, any type of retracement here, you're not going to see the 3,600 bottom again, and that would represent a buying opportunity because that type of retracement is going to be in what's likely to be a mild recession. Why mild? There's just not a lot of leverage in this economy. Banks are well capitalized. The businesses are well positioned. This is very unlikely to be a significant recession. We're just working off this bizarre COVID cycle. And that's why the Fed's going to be done sooner than later. And that creates over the next years a nice backdrop for investors.
And so we'll hear some of the meeting minutes from their last meeting this week. We're also going to get more data for them to really parse through at their next meeting in the form of jobs. And so what do you expect to begin to show up in that data, if anything materially different from what we've already seen in the monthly jobs report?
I think what the Fed really needs to see before they make the next move at the July meeting is the senior loan officer survey. So they will have the summary of the survey when they meet, when they get together at the July meeting. We will not see that until the following Monday. But what we have seen, the signs from other data, from the Texas lending survey and some commentary in the Beige Book is telling us that lending conditions are tightening and tightening pretty rapidly. So that will put us like a brake on economic growth in our view. And this is something the Fed is waiting for to see how it impacts the economy. It's probably not just another, inflation report or another payrolls report. Those data are obviously very important to the Fed, but they also need to see what kind of an impact their past tightening is having on the economy.
All right. Yelena, Brian, stay with us. We've got much more to discuss this morning. Shifting gears overseas, Asian shares ticked lower this morning after weak services industry data out of China renewed concerns over the country's faltering economic outlook. U.S. futures followed suit, slightly down as traders eyed headwinds for the global economy. With recovery efforts in China yet to find some stable footing, what does this slump mean for the U.S.? Joining us now, we've got Yelena Shaletyeva, who is the BNP Paribas U.S. economist, and Brian Levitt, who is the Invesco global market strategist here. And Brian, as we think about more broadly what this has meant over the course of this year with all of the anticipation for India and China being the leaders in GDP growth globally for 2023, what does this weakness kind of spell out for the rest of the global growth environment?
Global growth is slowing, and there has not been anyone that has stepped up to be the big catalyst for economic activity. Yeah, the U.S. consumer has hung in there, but the Fed's putting an end to that. And, China, there was a lot of hopes as they moved out of zero COVID that it would look similar to what we saw here in the United States, but still challenges of confidence and, coming out of a very rough zero COVID world. So you just did not get the type of pop. Now, what matters more, and we're not going to be back in a very robust growth environment. We're just not. There's just nowhere when you look around the world that's going to be the catalyst for that. So what matters most to investors is going to be the direction of it, not the level of nominal growth. What you'll see now from the Chinese authorities are steps to provide support for economic activity. They recognize that they need to do that. And in the U.S., what you'll start to get is the Fed that's backing off of its tightening stance, given the slowdown in growth in the U.S. and globally. And what that typically portends when the Fed's done raising interest rates is some moderation in the dollar. And that moderation in the dollar leads to capital moving to other parts of the world, which would be a good sign for the cycle and a good sign for the risk on trade. And what a lot of investors are going to recognize, and I think they've recognized for a while, is just that valuations are cheaper outside of the United States. it's been tough to be there as a U.S. investor because of the dollar strength and because of tighter policy, but that starts to wane. So for investors, focus on better, or don't focus on, the fact that nominal growth is not nearly as robust as once hoped. We're in a world where we're shifting from most we're tightening to either we're on pause or most are going to start to get accommodative, which, again, creates a better risk backdrop for assets.
Yelena, I got to ask you, so in terms of the kind of fits and starts we're seeing with regard to an uneven recovery for China, what is the impact that you see in terms of the U.S. economy?
So the U.S. economy is a largely domestic economy, but obviously there are a lot of links and it's all intertwined. But at the same time, we see imports from China are getting smaller in terms of a share of total imports. And that's probably why they seem to be open to talks with Janet Yellen. She's going there today. So I think what we need to see is continued talks with China, but at the same time, we are not so much dependent on them rather than they depended on us. And I think we will see a slowdown in the US economy regardless of what happens over there, because the lagged impact of Fed tightening will start percolating through the economy regardless of what is going on over there.
So lagged impact of Fed tightening, what other potential headwinds do you see for the U.S. economy? Is the inverted yield curve still a problem? What else are you seeing?
Well, banks, the banking sector, it still remains a question whether, what happened back in March in terms of the banking sector, the developments we saw, is it over completely? We don't see that many headlines about that anymore, but it doesn't mean that the banks are all clear, about this. So I think we may still see some tightening coming from that front, and that could impact the U.S. consumer.
All right, we're going to put a pin in this for right now. Brian Levitt, we want to thank you as well, Invesco Global Market Strategist. We appreciate your insight. We'll certainly talk to you again in the future. Yelena, you're going to stay with us. A new survey from the Dallas Fed is showing lending conditions didn't change much in mid-June, which our guest says could be a sign of further deterioration to come in the Fed's next senior loan officer opinion survey. Yelena Sholetieva, BNP Paribas U.S. economist, is back with us. So we don't have that senior loan office sleuth. I can't even say the whole name yet, right? But the Fed will have it at its disposal. What does the Dallas Fed survey tell you about what we can expect from the sleuth?
What really concerns me from the Dallas Fed survey is not only tightening in lending conditions, but also weakening demand from the consumer and from the companies as well. So there's commercial and industrial loans, and you see a slowdown in demand on that front, and that is your investment sector of the economy, and you also see a slowdown in demand from the consumer. Of course, we do talk a lot about how consumers would love to buy more cars. There's a lot of demand and still not enough supply. But overall, consumer demand is slowing for borrowing. And that is a big deal for the economy. And I think what was evident in the Texas survey, which is a kind of a microcosm of the United States, if you will. But you can also see that on a nationwide basis. And we could see that lending conditions tightening, slowing demand, will start to slow down what consumers are doing.
I mean, when we think about how this impacts small businesses as well, any tightening of credit conditions and small businesses' representation of, 50% of U.S. GDP, what kind of broader impact could that mean for the economy, considering the blow to small businesses that could create if there was an extreme tightening in lending conditions for them? Well,
small businesses also represent a big share of payrolls, of hiring. So if they slow down the hiring process, that will impact different sectors. For now, what we see is, there's been a lot of structural changes due to COVID, and still a lack of workers in leisure and hospitality sector. So that's why we see robust hiring in that sector, which is represented by small businesses to a large extent. So there's demand there, but if we start losing jobs in higher paid sectors such as finance, high tech. We have seen a lot of layoff announcements. So you cannot really replace all these higher paid jobs with lower paid jobs and have the same level, same growth in income, because that's going to be a hit to personal income growth, and that's going to be a hit to personal spending as well.
Then you need two for the price of one.
Which is exactly two, because average hourly earnings in the tech sector and finance are twice as large as those in leisure and hospitality, for example.
And I want to ask you a quick question. You talked about the consumer. The consumer has held up very well in terms of the economic cycle in general. Are you expecting the consumer to continue to hold up, especially with tight lending standards, through the balance of the year?
We already see a slowdown in the goods sector. So we're not buying as many, sofas and backyard equipment, whatever.
Okay.
What we haven't seen so far is a slowdown in services. We're still going on vacations, and I think we will see that in the second half of the year as all those high-paid jobs start to, shrink or at least slow down, and people will get more cautious about spending on services.
All right, you said the magic word for our next conversation. Stay with us for a hot second here, because we've also got some big economic data on tap this shortened trading week as we look ahead to the June jobs report on Friday. Elena Shaletova, who is the BNP Paribas senior U.S. economist, still with us. All right, headline figure, what should we be expecting here?
Well, we are expecting 230,000, and we expect a little bit of a retracement in the unemployment rate. So these are the top line numbers. But I think what will be more important to see is what private sector jobs are, because the headline number could be distorted a little bit this time in June and July in particular by scarcity of teachers. And those of us who have young kids, we know that there's a lot of questions about how to get more teachers, and we don't have as many. So what it means is that seasonally adjusted numbers will probably be a little bit more elevated because we're not laying off as many teachers as we usually are.
Right.
Because there are not as many. So the headline number could be a little bit elevated, but what we need to look at is the private sector jobs. That's where all the high-tech jobs are, finance jobs. We need to see whether this is holding up or not. And that will mean a lot for what we expect for economic growth.
But couldn't the growth in AI be supportive of the case for continued strength within tech jobs?
Sure, but that's not what we're seeing, right? That's probably a longer-term perspective, I think. It's probably not imminent. So we do expect a downturn, and it may not be a very severe one. It will be a mild one in our view, but probably this is something that would help us increase productivity going forward, and it's good for growth, for potential growth going forward. Probably not as much in the second half of the year.
I was really excited to speak about jobs with you this morning because we're in the midst of the experience economy season. People are out there, they're active, they're on vacations, they're trying to either make their flights or make sure that the flight still takes off to whatever extent that they can do so. But right now, it seems like there's a disconnect because there's still leisure and hospitality that is about 2.1% off of its pre-pandemic level here, at a time where you've got some of the CEOs of travel, leisure companies, accommodations companies saying that demand is at this counter-cyclical recovery or resurgence as opposed to the rest of the economy right now. So how do we kind of pair that together with what we're seeing in the demand versus where the amount of workers are for leisure and hospitality?
Well, I think the answer is twofold. So first of all, we have a lot of excess savings, but they're dwindling really quickly. So we are basically expecting that to be over by the end of this year. So that what was driving growth in the services sector, because people who still had savings, they were spending on vacations because we were so eager to go out there and finally go somewhere on vacation. But another thing is the strength of the labor market, right, overall. So as long as we have jobs, as long as we see increases in paychecks, yes, we will keep on spending. But that is, the issue here is that a lot of higher paid jobs, they see a lot of layoffs at the time. So, and again, my argument is that you cannot replace all this, high-tech, higher-paid jobs with jobs in leisure and hospitality. That will impact aggregate income growth, and that in turn will impact overall spending on leisure and hospitality and vacations. So you cannot just have a recession in one sector of the economy. When it starts, it affects everybody.
I hear you. I guess probably the skepticism that's on my face is I've underestimated the payrolls number month after month. I've given up trying to even make a tally because, we keep blowing past them month after month after month. So it's kind of hard to see the expectation for this downtrend. And especially like when you make the point about the high paying jobs, sure, they are being impacted, but there's more jobs on the lower end of the scale than on the higher end of the scale, relatively speaking. So I guess what's my blind spot here?
Well, you're not alone, right? So it's been it's surprised to the upside for 12 months in a row. So 13 may be a lucky charm. So I don't know. I think jobs have been resilient, and there have been a lot of structural changes again. So there's still deficit of the lower paid jobs out there. That's why companies are hoarding the existing labor force. We did see some declines in jobs plentiful if you look at the consumer survey. Right. So they're not as plentiful, and we do see a confirmation in Indeed data, so the company that tracks job openings. At the same time, companies are not laying off people en masse. So, and that's where the disconnect lies, I think. So we're not seeing as many hirings. That's what I'm trying to say, which will, I think, eventually get into the layoffs stage.
Cycle. Okay.
Elena Shaletyeva, who is the BNP Paribas Senior U.S. Economist. Thank you so much for joining us here this morning.
Thank you.
Appreciate it. Well, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Second half, companies I'm looking forward to covering the most, I would say it's cruise lines, honestly. I'll never go on a cruise, but I am excited for a lot of the fervor that has reinitiated, or for the companies that have been able to re-engage with a lot of the demand that has been pent up in the experience economy, and for cruise line operators that have been trying to bring people back on board, make them have a better vessel experience, and ultimately see a higher ticket or amount spent on those cruises. I think cruises have been off into the races, or off at sea, and doing quite well.
I don't know what mine would be. I mean, one of the interesting areas I think we'll continue to watch will be home builders, which have really gotten interesting here as we get into the second half of the year, because they have been responding to the lack of inventory on the existing home sales side by really ramping up their inventory. So the housing market, not just the home builders themselves, but what we see from housing overall, I think is going to continue to be interesting.
All right, you just had the opening bell on Wall Street in this holiday shortened trading week. Let's do a quick check of the major indexes. You have all three under some pressure in the early action. Dow, S&P 500, Nasdaq, all lower, a little more than 0.25%. All of them Dow down by 0.5% as investors wait for the Fed minutes. Let's get over to Brad Smith at the Yahoo Finance Interactive. Brad, what are you watching?
Got you covered over here. Year-to-date view. We'll start things off there as we essentially kick off the second half. Yeah, we already did have one trading session, but it was abbreviated, so we're not really going to count that one. It's a half. But here, as we take a look at the beginning of the second half of this year, we are down for the Dow Jones Industrial Average. We're lower by about 0.5% out of the gate this morning, as you mentioned, Diane. Year to date, though, you're still seeing some gains for the Dow of about 3.3%. So we'll see exactly what the second half holds. We've got much more that's about to kick off once earnings season commences as well here in the coming weeks, as well as the Nasdaq Composite. I've got that pulled up for you here on the day. That's down by about 0.3% to start the day. But yeah, year to date, it's been off to the races here. If you were taking a look at the past 2 years, though, this is where we still got some ground to make up. Of course, last year took an L. This year, hoping to bounce back. S&P 500, you're seeing that to the downside as well right now by about 0.4%. We'll give you a year-to-date view of this one as well, just to round out our coverage of what we've seen actually transpire over the course of this year thus far. We are still holding on to gains of about 15.6% in 2023. However, getting the second half down or off to a bad start, if you will. Let's take a look at the heat map here for the 11 S&P 500 sectors. We've got them loaded up for you here on the screen. I wish I had better news to show you, but we've got red across the board. So we will be brief on this one. XLB, though, the largest of the laggards, that's down by about 1.4%. And we'll ride out with a quick look at some of the mega cap tech stocks. Some mixed activity, but largely red on the day.
All right, yes. Oh, like the heat outside, red hot.
Where's the AC?
Exactly. All right. We're also keeping an eye on Tesla shares. The stock has been flip-flopping this morning after strong production and delivery numbers. Now, total deliveries for the second quarter coming in at 466,140. Total production at just under 480,000. Both of those numbers beating expectations. The stock was initially higher, but again, we had that holiday shortened trading day earlier this week, so saw a bump then. Now, the company's performance in China could be seen as the big win here. Deliveries from Tesla's Shanghai plant rose almost 20% from a year earlier. Tesla's still been having a moment. I know the stock's flip-flopping right now, but it's been seeing some strength recently. Remember the pricing cuts, that seemed to have helped.
Pricing wars, yeah. Pricing wars has been a big story for Tesla, and that has really pressured some of the other automakers to just think about where they can either tell the story about credits that would be able to be applied to some of the purchases among potential or ecosystem customers that they may have. But year to date, you're taking a look at Tesla shares, still holding on to gains of about 125%, just a little bit over that. And I think as we move forward from here, the story really is going to continue to be about where Tesla, as this company does not have the traditional dealership type of model, is able to communicate better on pricing, make sure that even as the cohort of electric vehicle purchasers continues to rise as a percentage, at least, of total vehicles sold here in the U.S. and more broadly around the world, where they can maintain market share as some of the larger auto manufacturers are ramping up production, whether it's Ford, whether it's GM. They certainly have some lofty goals over these next few years. And a partnership actually on the charging network front that could be strong, at least as perhaps a rising tide, to make sure that consumers know that there will be more availability for people to not gas up, but just charge up.
Right, exactly.
Charge up. All battery. All right. Tesla isn't the only EV maker that we're watching this morning. We got to talk about ticker symbol RIVN. Shares of Rivian, they are on the up and up as the e-commerce giant says Amazon, e-commerce giant Amazon rather, says it's rolled out its first electric delivery vans. It expects over 300 new electric vans from the company to start operating in Germany in the coming weeks. If you're surprised by this partnership, you probably shouldn't be, given the fact that Amazon and Rivian have had a relationship, at least in form of one of their owners or founders, and the investments that they've made over the years.
Right, the stake and then the vans now. So this helps them in terms of penetration overseas, obviously, and they're performing better in terms of they're actually executing on that goal this year compared to last year, because they disappointed last year in terms of delivering the vans. I mean, it helps not just with brand penetration, but also, of course, just being able to collect data in Europe and, helping it to tweak its platform, its software, And then, of course, Rivian, we know, is expected to be a bigger player in the EV space. Obviously, Tesla is the leader in general, but Rivian expected to be, to bring in some strength there over the next 10 years.
And this is why people should pay attention to this, too, from an investment perspective. When you think about Rivian and their ability to move more of the commercial sales forward for vans. Rivian, great movement forward for them. But Ford Pro is also one of the plays where we've seen some of the commercial interest among investors really looking to where some of these commercial deals are coming forward. So Ford Pro, of course, GM and their own BrightDrop. And then you think about Tesla and their large orders that they still need to move forward with as well. And I think those commercial sales really being able to prop up, or at least have some type of bridge for where they're not seeing, or if there was any kind of destabilization in the amount of end consumers on a household basis that are purchasing electric vehicles, those commercial sales could at least be a buoy, or at least a stabilizing effort for some of the EV manufacturers too.
And we're not just going to talk EVs. We can't do the whole show on EVs. We got some positive news for Netflix this morning after the streaming giant got an upgrade from Goldman Sachs from sell to neutral, with analyst Eric Sheridan saying Netflix has regained content creation momentum and executed its password sharing initiative. So you're seeing the stock get a little pop there, about 1.25%. I mean, Eric saying in the note that the recommendation before was based on some headwinds, the sell recommendation from the post-pandemic subscriber growth, but saying that he sees the execution of the password sharing playing out better than expected. I guess it hasn't turned people off to Netflix.
It has not, no. In fact, it's kind of worked to their strategy, at least that they had laid out on onset, of making sure that they were cracking down on password sharing. They also said within this note that they've regained content creation momentum in a manner that has muted any post-pandemic growth headwinds, and overall industry competition has become more muted, especially from traditional media companies in the past 6 months. It's also probably worth noting on the content creation front that we are still in the midst of a writer's strike.
Right.
As we were told by the chairman of UTA, Paul Wachter, out in Canada a few weeks back, we could potentially be looking at even an actor's strike. And so with that, the content costs are certainly going to be coming in focus among investors, where they're looking across how much companies are going to have to spend in this near term just to make sure that they are still creating content that keeps people on these platforms as well.
Yeah, and that's why they're also expanding their international content efforts, preparing for a potential actor strike as well.
Absolutely. All right, we're going to continue to track that, but we are also tracking stocks having a big first half fueled by hype around generative AI. But according to Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, just 7 stocks fueled most of the S&P 500's 15% year-to-date advance. We know all about the most loved stocks, but what about the ones longing for some affection here, waiting for somebody to swipe right on them? Yahoo Finance's Brian Sazi, hey, weekend mode Brian Sazi, has his 3 picks for the months ahead here. You look good.
Well, one of my picks was the shirt I'm wearing. This is just great.
I like
this is great.
it.
Strong buy on my slim fit shirt. All right, well, let's get to some stock picks here. Real cool piece from our Shawna Smith, our senior anchor in the afternoon, and yours truly now on our homepage, looking at how the markets have really had a really strong first half, double-digit gains, led by, in large part, a lot of those big cap tech stocks, AI names. But if you look into this piece, there are a bunch of stocks that the market absolutely hated. First on the list, that is AT&T. First half or year-to-date performance down 13%. Investors really concerned about slow collections, people paying their bills late because of economic troubles. But the people we have talked to are starting to warm up a little bit on AT&T, seeing perhaps a little bit of an economic turn in the back half of the year. The company's cash flow position may be improving a little. That might have people returning to AT&T, which has had a really tough 3 or 4 years or so. Next stock, which is a little bit surprising here, guys, that is Occidental Petroleum, Warren Buffett's favorite stock, but more of this stock last year. Surprisingly, despite Buffett's big buys, shares down about 8% year to date because of the pullback in oil prices, which have been driven by fears about China demand and a U.S. recession. But as you get some more OPEC supply cuts, as was announced earlier this week, you could see oil prices start to turn higher. Perhaps that Buffett's favorite stock, starts to get a bid. And last but not least, Cisco. Shares up 7% year to date, so it's been doing well. It just has relatively lagged the broader double-digit gain in the S&P 500. I think investors should go back to a name like Cisco, look at the company, what they just reported a couple months ago. They will see double-digit sales. They will see a more streamlined organization after some layoffs, and maybe a lot better fundamentally, just a better fundamental business than a lot of people expected.
You know, this is really interesting, and you wrote about non-tech companies not faring well. CVS Health, another one you mentioned, is down 26% in this story. Were there other kind of weak spots right now that even within their own weakness, investors could perhaps look for a type of bounce back at all from what you were seeing in the data?
Well, I see there are names. There are striking underperformers. You mentioned CVS Health. Walgreens has also been an underperformer. Those stocks with losses of over 20%, it's hard to warm up to them. Where is the catalyst for CVS Health? Maybe is it a really strong flu season in the fall? Unclear. So I don't think you want to go out there and try to, throw darts at some of these names. You have to look for clear catalysts. Cisco, a clear catalyst, improving business model, improving cash flow at AT&T. There has to be a reason to get involved with these names. Out of all of the 3 names we mentioned, Occidental Petroleum looks very intriguing. Again, these are not names I'm saying to buy. That's not what we do here at Yahoo Finance. But again, there is a fundamental setup to get excited by a name with Occidental Petroleum. And if Buffett is throwing billions at it, who the hell am I to argue with Warren Buffett?
Right, but is there a case for Occidental to pay for my child's college? I'm years out,
Wow.
10 years out.
Well, if Warren Buffett invests for eternity. So who are we to argue Warren Buffett's track record? If he likes this stock, why shouldn't we?
Yeah, he's probably got Tony Stark's arc reactor
I think
somewhere.
he has the same shirt too as me.
He does,
Buffett,
actually.
yeah.
We've seen that.
Slim fit.
He was probably wearing it at the annual shareholder meeting.
Always good to see you guys. It's a real pleasure.
Yahoo Finance Executive Editor Brian Sozzi joining us here today. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's the biggest risk for the second half of the year?
It's got to be the Fed. Fed Chair Jay Powell has already said that he's not going to rule out not just one more potential rate hike, but consecutive rate hikes that could potentially come in the second half.
Yeah, I think that's right. I think that we don't know when the hikes are coming. We don't know in what, how close together they might be coming, right? And then there's always some other risk that we don't anticipate, of course, but we don't know, we don't know that until it happens.
President Biden's countrywide Investing in America tour is underway, highlighting the manufacturing boom fueled by the administration's legislation. Private companies have committed some $491 billion in investments so far across industries like semiconductor and EV manufacturing. But critics argue the mad dash to invest in clean, renewable initiatives comes at a great cost to investors, taxpayers, and American workers. Here with more is Alicia Finley, Wall Street Journal editorial board member. So, Alicia, let's dive right into this. You put out a piece a couple days ago diving into Bidenomics. What is the cost that you see?
Well, I think the problem is that the government is distorting investment. And whenever government picks winners and losers, there are often more losers. And those losers are the taxpayers mainly. In this case, the Inflation Reduction Act, it was estimated to cost about or just the climate subsidies, about $370 billion. But some recent estimates from outside groups, including Goldman Sachs, are saying it's actually going to cost $1.2 trillion or more because all these companies are rushing in to exploit the subsidies. Now, the problem is that when they're in their rush to exploit the subsidies, oftentimes they're ignoring quality control issues. But also, again, the investment is going to these, for instance, electric vehicles, but also carbon capture, hydrogen, other, inchoate technologies that otherwise really aren't fully developed. And really, when private government dictates where capital flows, you create misallocations of capital, and that ends up in purely economics terms, a deadweight loss.
There's always been an issue, though, tracking to see and making sure that there is the appropriation of funds that gets carried through to where those funds were intended to go towards. And so what steps do you believe could be taken both in the public and the private sector to improve that transparency so that both taxpayers as well as investors know where some of the overall commitments have actually netted out and what the results have been?
Well, I think that they should be required to report on how they're the companies that are receiving all this money. And some of this is in terms of grants. Some of it, and again, this is actually, it doesn't just impact the climate subsidies. Also, you have the bipartisan infrastructure bill as well as the semiconductor bill, which allocated almost $200 billion to the chips industries. Now, I think that the companies who are receiving the money should be required to report on how they're using it. Now, I don't think that the government should impose other restrictions as they are, such as requiring the companies in terms of the chip makers to provide basically free childcare or imposing some kind of profit sharing requirements. They should be required to at least show how they are using the money. But of course, my position or belief is that the government shouldn't be giving this money in the first place, and that they should actually be raising money from private investors. And if these projects or programs are really worthwhile, they shouldn't have a problem raising money in the private markets.
And so, Alicia, I got to ask you, so where do you see his challengers potentially putting a pin in terms of what they can do to counter Biden?
No, I think that they have an opportunity to highlight some of the other jobs that are being, again, destroyed in this, rush to, or as I deemed it, a green energy subsidy rush. You saw with Ford announce that it's laying off about 33,000 employees as it tries to gear up its electric vehicle production. The United Auto Workers has estimated this EV transition is going to cost it 35,000 jobs. You're seeing jobs lost in oil and gas. Again, these are good paying jobs. And so I think that they could just highlight, yes, there are some jobs being gained in some places, but you're also seeing jobs lost in others. And the problem is, workers, we saw this 20 or 30 years ago, right? When you saw a lot of jobs lost in manufacturing. Well, yes, there are now new jobs, but it does create some economic dislocations. Workers may have to move and such. And ensure if the new jobs are more productive and pay more, there's an economic argument for it. But here, the problem is that they really aren't creating any great improvements, technological improvements that will increase productivity in the long term.
And so, yeah, I mean, I guess, even as we think about what qualifies as a good paying job relative and up against either what your kind of living situation is in certain regions or what inflation is, as all of this is kind of a part of a larger cycle, of course, all the time that we have to go through, where it's, okay, if there's job displacement in one arena, perhaps there's a better job that comes across later on. Does anything within, or what you've seen within the administration's efforts to make sure that we are either combating inflation or having infrastructure move forward to create, better roads, bridges, technological advancements, what have you, that those jobs are actually paying well enough to offset the cost of living, to offset inflation as well?
Well, the problem is that a lot of these jobs, again, they don't in the green energy, and actually what often gets overlooked is that green energy actually isn't as profitable as oil and gas right now. But those jobs don't pay as well. And so there again, you're right that there are dislocations. I think the government is now trying to mandate prevailing wages. These are essentially set by the unions on a lot of the semiconductor projects, and wind energy and such. And the Inflation Reduction Act actually includes bonus tax credits for companies or developers that use or agree to follow prevailing wage requirements. Now, these are just actually the issues that they're going to raise the cost, and then they may make the projects less worthwhile. So it's essentially now government is also now trying to dictate wages, which opens up a whole new can of worms.
Alicia Finley, who's the Wall Street Journal editorial board member. Thanks so much for taking the time today. On Monday, Saudi Arabia and Russia announced plans to extend oil cuts through August. These latest reductions coming after a round of OPEC cuts have yet to give a lasting boost to prices. Yahoo Finance's Jared Blickery joins us now. He is on Wall Street at the New York Stock Exchange. Hey, Jared, good to see you.
Yeah, thanks, Brad. Let's take a look at the Wi-Fi Interactive, because WTI crude oil is in the bottom end of its trading range for the year. And what the Saudis and OPEC Plus are trying to do, and when I say OPEC Plus, that largely means Saudis plus the Russians, they're trying to keep that level, these lower levels, from being breached. They want to support the oil market. Now, you take a look at a two-year chart, you can see how really it's come down to the bottom end of its range there, and really the volatility has also lessened. Usually that's a good thing for the prices here, but I think what the Russians are saying with this, because they were not a part of the last increase or decrease in output, they are saying that they are on board with the Saudis, at least in name. Now, we saw what may have been an attempted coup before. You want to mess with Russia, you want to mess with Putin, go after their money supply. That comes from oil. That's their largest source of revenue, or at least one of them, especially with their hampered economy here. And crude oil, when you take a look at the longer term charts, maybe this will save it, maybe it won't, but the China story never really materialized this year, and that's a completely different issue. Let's go to the our energy heat map page, and year to date we can see kind of a mixed board, but more red than green, and this is definitely a switch from the last year when energy was by far the only great performing sector out there, up about 50%. If you notice, some of the foreign majors like Shell and BP, those are up, but most of the other companies are in the red, and that's in the US. There's a different capital structure. Shareholders expect different things from US companies. They want money returned to them. And then you take a look at the growth profile, or what's been making money recently. Okay, so we had tech in the beginning of the year. Over the last month, we saw kind of a reopening trade. We saw cruise lines come into favor. We saw airlines come into favor. Industrials and materials still haven't quite seen energy come back in favor. So what's it gonna take? We were talking about Occidental Petroleum earlier with Brian Sazi. Maybe Warren Buffett's interest in it will finally leak into some more investor sentiment in the arena. But I think what it's going to take is price improvement, and that simply gets back to the price of oil. So crude oil, what is it now? I'm going to pull up the chart. Oh, let's see. We got looks like there we go. CL equals F, 2.5% up to 71.54. Probably going to have to hold about 65. They'd love to see it. Saudis would love to see above $80 a barrel, because that's a different genre. That's a different trading regime. We haven't seen those prices since probably mid last year. And in fact, we actually got up to about 120. That was on the Russia news. All in all, a little bit of a surprise out of OPEC, but the Russians are going to have to follow through. They have promised these cuts, 500,000 barrels per day next month. all right? So in August, and it's going to be a while before we're able to track that, and I think that's going to be where the rubber meets the road on this one, guys.
All right, we're going to continue to track that, as we know you will as well. Jared, thanks so much for breaking that down. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's been your favorite company to cover this half?
Definitely Meta. Meta Platforms, I think, laid out the blueprint for anyone who wanted to, or at least dip their toe in the generative AI waters out there. They, in Mark Zuckerberg's commentary on the call, talked about the A, the M, as I put it, and the C. AMC is what you need to remember. The applications that live on top of the language learning models. I was a little bit generous in calling that an M, but also at the base of it, the C, you've got the chips, and that's where a lot of investor attention has been thrust towards.
And the chips is where it's boring, right? But NVIDIA has been the most interesting thing to cover, I think, this year thus far, because it has sat at the center of the whole AI discussion, and also because it came out and showed the evidence that all of this AI hype was actually translating into revenue for this company. So I think that's where I'm going to be watching what companies are actually not just talking about AI, but actually making money from it.
Welcome back. You're watching Yahoo Finance Live. Brad Smith here with Diane King Hall. We've got some great interviews on tap next hour. Coming up, why our next guest is calling the first half of 2023 a year of contrarian market gains. We'll speak with an economist from Citi next.
Plus, a pulse check on the transportation sector. We'll speak with an analyst from BofA Securities in the next hour.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's the first thing you drink in the morning?
Water.
Water, really?
Of course.
I sit right next to you. I never see you drink this water.
I drink it at home. I drink it on my way into the office.
Okay.
Drink water. That's
Fair enough.
the first thing.
Those are two environments that I'm also not in.
Coffee's later.
That's fair. Coffee is my first thing that I think I drink in the morning, but I don't do like some of the other unnamed people on our team and go to Starbucks and get a $9 drink or to any of the national chains. Support your local businesses if you're getting that cup of coffee in the morning. I kind of hyper-oscillate between two that are in equidistant areas of this office.
I just love that you put in this question as a reason to criticize the people on our team who buy
I'm just
from
trying to
large
encourage
chains
spending,
every morning.
buy local, everyone.
Buy local, or just turn on your tap.
It's shortly after 10 a.m. here in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Brad Smith. We're just about 30 minutes or so into the trading day. We're watching shares of Coinbase, the stock dipping this morning after Piper Sandler cut its rating on the crypto platform to neutral from overweight. Analysts also dropping the price target for the stock to 60 from 65. So it's still got a ways to go. This comes, the price target set to 60 there. So Coinbase under a little bit of pressure this morning.
We're also watching shares of UPS. Shares are slipping as labor talks between the logistics company and Teamsters hit a roadblock. UPS says the union stopped negotiating, while Teamsters claim the package delivery company walked away after the group rejected an offer. The two have less than a month to come to an agreement and avoid business halting strike.
Meantime, we're looking at Hertz, that stock popping today as Jefferies analyst Stephanie Moore initiates coverage of the company with a buy rating and a $25 price target. The analyst pointed to potential upsides in pricing and margins, as well as the company's partnership with Uber to rent Teslas. Hertz still coming out of its 2020 bankruptcy filing, so you're seeing a little bit of a gain there, up 1%.
Taking stock of the first half of 2023, a few big tech names led an AI-fueled rally, sending large-cap tech stocks surging, and small and mid-caps underperformed in comparison. With recession fears mounting, investors are looking for areas of opportunity as we enter the second half. Joining us now, we've got Stephen Whiting, who is the Citi Chief Investment Strategist and Chief Economist as well. Many hats for Stephen. And Steve, we appreciate the time taken here with us this morning. So first, perhaps we look back to the first half of 2023 and perhaps pull forward any of the themes that could still be at play from your perspective.
So it's been an environment where investors have been very defensive. Money fund assets have surged 42% over the last year. So better returns on money funds, but doesn't explain a surge that is that rapid. Very large bets against the market. And if you take a look at last year, for example, our single largest overweight industry position was large cap pharmaceuticals. That's again, defending, worrying about a recession. Now, you mentioned it earlier, we had a nice reversal in tech this year. AI has been the industry catalyst, but this was the underperforming market last year on rate fears. So when you think about what has happened here, it's been a big defensive trade in markets for a good long time. And now that we've had the Russell 2000 fall 25%, fall with the entirety of the 2000 companies below the level of, let's say, the value of Apple stock, we have to start thinking about cyclicals. Now, we don't have a good outlook for the economy for cyclicals in the near term. But when you think about what's going on right now, you saw it in the ISM report for June, we're getting manufacturing readings in real recession. We're clearing inventories. We're having the single family home building sector shed inventories. A lot of these traditional industries are already deep in recession. They're not going to have a recession out in the future. It's now. So this is the time where you can start building positions in cyclical industries again, the assets that have been left behind.
So, Stephen, should defensive then be on the back burner in the second half of this year?
I think so. Look, it's not as if this is going to be easy and resolved over just a mere few months. But when you think about the next 12 to 18 months, we're getting enormous discounts, 30% on small caps. You could take a look at shares around the world, 11.5 times expected earnings versus 20 times for the S&P 500. This is, again, all about that defensive trade. And defense is not working. We have had an emphasis on the best quality dividend growth companies. Shares are up very little this year. And again, those are the trades that really worked well and added tactical value last year. Now, they may be good strategic holdings. We don't argue against this. We love the pharmaceuticals industry for the long run, but they're not adding tactical value. They become crowded trades.
Is there a theme or a common denominator that you anticipate emerging in the second half of 2023?
Well, the one thing that investors should not expect, and this has been very much their expectation, is that there will be some singular moment of collapse in the economy and markets. They probably think back to the first half of 2020, or you could take a look back, if you have a long enough memory, to the second half of 2008. Recession was utterly clear. You just simply collapsed and all of your risk was behind you. It's not going to be like that in every likelihood now. Services industries had a depression in 2020. They're still trying to catch up and add headcount to get back to 2019 levels. I think they will slow. It's going to keep the economy restrained when they do slow. But this is not that environment where you just simply say, well, now we have the recession. Now we can invest again. And investors who did, and they stayed solely in cash, are trailing diversified portfolios by 700 basis points. So, I think we've come a long way, and double-digit returns in the S&P 500 are not something that we expect to repeat. but there's been great dispersion in markets, dispersion in valuation. This is creating opportunity, not just for the back half of the year, but in 2024.
And so if not a collapse, then what? Because correct me if I'm wrong, the city target for the S&P 500 by end of year is 4,000 right now.
Well, the S&P 500 is not the sole way that we would think is the best way to invest in equities markets. We're global investors. We're not bound by index targets. We have investments in cybersecurity shares in large cap US. We have investments in Europe and Japan and China. This is a very, very different performance valuation prospect besides the S&P 500.
Stephen, I want to ask you one question. This is a question I posed to another analyst. In terms of how the market is pricing the potential, like you said, this is not a 2008 Great Recession kind of scenario that we're looking at. Is the market priced right for the potential for even a mild recession?
I think it is in many respects. It's certainly priced for the rolling recessions that we're in right now. Where, again, the traditional cyclical industries, trade, manufacturing, construction, are all falling. They're all falling as rapid a pace as you're going to see. Now, there are still going to be constraints on growth, and the Fed is still tightening, focusing solely on labor markets, the one part of the economy, the one indicator that is truly outperformed. What I think is important about a little bit more optimistic view of the next 2 years, sadly, I think the Federal Reserve will achieve its unemployment goals, which is higher unemployment. But industries that are contracting now won't have to contract again. They have already contracted in terms of production. They're going to lose inventories. Non-farm business output has fallen 1% over the past year. The labor market in the next 2 years probably can underperform the economy. And I think that that's more positive for capital returns than labor markets compared to a very different environment in the past year.
All right, Stephen Whiting, stay with us. We want to do a deeper dive into the impact of China. More disappointing news from the world's second largest economy. China's Services Purchasing Managers Index fell to 53.9 from 57.1 in May. While not a contraction, the weakest print since January, China's growth faltered in Q2, causing investors to pull back. With the Hang Seng Index down almost 6% in the last 3 months, we want to bring back in Stephen Whiting, a Citi Chief Investment Strategist and Chief Economist. Stephen, in your note, you said you trimmed your allocation to Chinese equities in recognition of significant challenges. Can you explain that more?
Well, this has been a couple of moves. China's economy, from a long-term perspective, is an economy that's likely to have a solid cyclical recovery. It has a lot of runway, has very high unemployment. Headline inflation is zero. Monetary and fiscal policy are easing. That's just the complete opposite of where we are in the U.S. right now. All of the things that would get us concerned about the U.S., that we've sort of run out of capacity to grow with tight labor markets, just the opposite in China. Unfortunately, after this reopening from COVID, their economy really stalled in the second quarter. There was a sharp reopening effect. You have low valuations, you have, what should be low expectations. But even with double-digit retail sales growth, China's economy is not matching the hopes that everyone had for it. And they do have some very significant overhang from a really terrible real estate depression, much like 08-09 in the United States. And policy needs to take very definitive action, again, for China to reach its own growth targets. We think that action will come, but it's a riskier backdrop. It's very much more policy dependent, and China's not going to get help from the rest of the world from exports. Didn't help them during the period when they were outperforming, but these internal reasons, again, the lack of confidence in China right now is being felt very much in their asset prices and their valuations. Usually after these periods, returns are strong, but it can take some time and it can take some serious focus on action.
Even with that lack of confidence, should there be an investor out there that is still trying to put some type of international or global positioning within their portfolio? What's the smart play to then play the reopening in China right now?
Well, a couple of things. They have industry-leading technology in electric vehicles, in solar power. These things that are very emphasized as areas of development in China that are not, again, tied up in all of the geopolitics, again, of U.S.-China. And, again, you want to think about size. When you think about 2 decades of outperformance of U.S. equities, 62% of global market cap trading at a vast valuation premium to the rest of the world, you put some money to work in a diversified portfolio. Think about Brazil as another example. It's one country. It's going to trade very, very differently from the United States. 7 times earnings, 7% dividend yield, 9.5% real interest rate. That is very, very different from the U.S. So China and Brazil as examples, or Japan, these are all places, regions that look very, very different. And they will perform better when U.S. equities, when the large caps underperform. So these are opportunities, fuel for economic recovery in the future in the next couple of years at much, much lower valuations. You have to scale it properly. We have about 7% of portfolios in global portfolios in China. And that includes for investors in that region of the world as well as U.S. investors.
Stephen, so as we know, the U.S. and relationship with China is tenuous at best. What does that mean for the investor here? Does the investor here, especially when you consider where growth is with China and it's moving in fits and starts recently, does the investor here need to limit exposure, especially in a note that you shared with us that you called it, your headline was China between disappointment and hope. I guess, what's the hope?
Well, the hope is an economy with 4 times the population of the United States at a mid-level of income with a valuation about half the United States. And again, this can be a tricky issue. You can have constraints on the ability to invest directly in any of these economies, but we are global investors and we have clients all over the world, and we're putting portfolios together that take offsetting risks in particular industries. Idiosyncratic risk, country risk, has always been, again, the reason why global portfolios tend to have less severe declines during shocks. That's not been a worry for the U.S. in the last 20 years. That might not always be the case.
All right, we will have to leave it there. Thank you so much for joining us today, Stephen Whiting, Citi Chief Investment Strategist and Chief Economist. We appreciate you. All your market action is ahead. Stay tuned. You're watching Yahoo Finance.
You're on a long road trip. What's the first album you put on?
First album, New Nation Project, Kirk Franklin. Gives me vibes, takes me back to when my family used to load up the car, go to Hilton Head, South Carolina. You'd hear Kirk Franklin's raspy, deep voice come on.
You want to give us a little?
I mean, dude, you want a revolution. Whoop, whoop. Like, that is the essence of beginning a car road trip right there. Take you back to the late 99s, early 2000s.
Mine feels a little lame compared to that.
No, you know.
I would put on Billy Joel's "A Stranger." Just like everyone, you sing along, you know the words.
Yeah.
That's a good one for me.
That's a good one.
Congress heads back in session next week. Among the issues on the docket, regulation in the wake of March's bank failures. After a series of hearings, conversations about bank regulation seem to have cooled from earlier this year. The Fed's recent stress test results a welcome sign of the system's strength. Yet some lawmakers argue more oversight is still needed to prevent history from repeating itself. With a look at what's on the agenda, we're joined by Brendan Peterson, financial services reporter at Punchbowl News. So, Brendan, let's get right into this. What can we expect coming up on the docket?
Thanks for having me. Yeah, so we just saw the Senate Banking Committee last month pass on very bipartisan lines legislation that would make it easier for regulators to claw back executive pay and also give them new powers to remove executives from the industry for certain reasons and negligence and other conditions. It was a really remarkable amount of bipartisanship on the Senate Banking Committee, led by Chair Sherrod Brown. Something like every Republican on the committee except for 2 members agreed to let this thing go and send it ostensibly to the House. Where that goes next is an open question. I am personally not all that bullish at this time because the House and its Financial Services Committee chairman, Patrick McHenry, has made pretty clear that he doesn't really see the need for this kind of reform. He says pretty openly that, look, I will look at any legislation the Senate Banking Committee gives us, but lawmakers regulators already have this authority. You can claw back as much pay as you want using Section 956. I shouldn't say as much as you want, but a certain amount of executive pay. That's a rule from Dodd-Frank that has never been implemented, and he has brought that up a lot. So it's going to be hard for that Senate banking package to get through, and we'll be looking for signs of life. But like I said, I'm not exactly bullish.
How would they go about doing this? And perhaps this is for my own edification, perhaps that for some of our viewers as well. How does that process even go about happening?
Yeah, so typically when a bill passes out of a committee in a chamber of Congress, it gets sent to the sister committee on the other side of the building. The committee has the option to take it up. In the House, Patrick McHenry could schedule a markup on that bill or host hearings on that bill to discuss before going up into a markup. And then theoretically from there, they'd vote on committee, send it through or not. It's interesting, though, with this bill, in theory, like if Chairman McHenry was feeling like Democratic, he could host a markup, and if his members support it, it could go through, and if not, it would just go away. In this case, there's a fair amount of bipartisan interest in this kind of reform, and so there's a chance that even if McHenry didn't support it, other Republicans on the committee would, and I'm not sure he wants that. He, as the chairman, has the power to just say, you know, I don't really want to talk about this right now. There are other ways for Democrats to put legislation on the floor. You might recall during the debt limit discussions, we talked about a discharge petition, which is a time-consuming and sort of technical way to get things on the floor without the House's approval. But I do want to flag the banking industry does have some more meaningful concerns about this bill, as you can maybe imagine, about a law targeting bank executives. And I think we're going to see some of those concerns play out from the banking lobby here in the next little amount of time. But like I said, odds are fairly low of House passage.
So, Brendan, just let's widen out just a little bit in terms of what else is going to be on the agenda in the week ahead. So there's expected to be a defense authorization package coming up, more than $800 billion. What's expected to be in that?
Yeah, this is going to be a real battleground. And I think I want to talk about some reporting that my colleague Andrew Desiderio has been doing on this for a while. We expect the NDAA discussion to be not dominated per se, but there's going to be a lot of discussion about abortion. As you probably know, Senator Tommy Tuberville has been, no, it is Tuberville. I'm sorry. I'm getting back into the flow of things after the holiday weekend.
We all are.
Senator Tuberville has been holding up military promotions because he doesn't like the Pentagon's existing abortion policy. This has been getting blowback from certainly Democrats, but also a fair number of Republicans, especially in the Senate at this point. And he is using or trying to use NDAA discussions to kind of like hold court on this issue, trying to get the Pentagon to basically blink and adjust their abortion policy so that these promotions can go through. I don't see a exit from this. He has been very, very stubborn on this issue, despite being asked by colleagues on his side of the aisle to come to the floor or just relent on some of these holds that arguably are affecting national security by preventing our service members from going off and doing their jobs in new places. We're going to see more battle over this. We might even see some resistance from House Republicans when the NDA is being decided. But beyond that, we're going to have to just wait and see what that markup brings.
Brendan, just lastly, while we have you, we do know that there's a lot of focus as well in terms of the range of issues that are being taken up in Washington right now. There's some focus as well on the cannabis banking as well after their recess. Is this going to move forward at all? What would this set up for some type of federal legislation, if any?
Yeah, cannabis banking, specifically the SAFE Banking Act, which is a law that would basically, or a bill that would make it easier for regulated financial institutions to work with cannabis firms. I have an old editor who would call this the Lucy's football of Charlie Brown issue, because every time it feels like it maybe is going to happen, we get really close to the finish line, and then whoop, it gets pulled away, and we are back to the drawing board. This time around, the Senate Banking Committee is interested in taking up cannabis reform when it comes to banks. That's not something that was true even a couple years ago when Sherrod Brown was still the committee chair. But this has become more of an issue for Democrats. Cannabis reform is a big issue for Chuck Schumer. And so they just have that as a priority. We expect them, if not immediately next week, at some point after the current congressional recess, Congress is going to come back and the Senate is going to think hard about cannabis banking, and they're looking for bipartisan support. This is an issue that in general does get a lot of Republican support. It's a business-friendly issue. There are some public safety elements to cannabis banking reform because the current system allows for a lot of cash to be in the system. The real trick is going to be the House again. There is, again, just with clawback reform, there's some real bipartisan support here, but Patrick McHenry does not support cannabis banking on his own. He has said he will not get in the way of it, however. So there is some room here for compromise, but it's hard for me to say exactly what the House package is going to be looking like, because in the House, you actually mentioned the NDAA, sort of related tangent. The top Republican in the House who's working on cannabis banking is David Joyce of Ohio. His top issue has been Homeland Security funding and appropriations process right now. I ask him basically every week, hey, how's cannabis banking reform going in the House? And he has said to me a couple times, I got my own stuff I'm worrying about right now. We'll get to it when we get to it. So the House's attitude is a little bit lackadaisical on this particular point. I think we'll see some movement, but we haven't seen evidence of that just yet.
Interesting. All right. Brendan Peterson, financial services reporter at Punchbowl News. Thanks so much for joining us and breaking down some of the conversations you're having over at the Hill, too.
Thanks, Brad.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
I mean, I'm a burger girl. I like burgers, right? A very simple burger on the grill is a joy, right? Corn on the cob on the grill. Yeah. I also like potato salad, which is not for everyone.
Throwing that on the grill?
No, but I do like potato salad.
It's a grill annexed type of
Yeah, it's a barbecue food.
It's a barbecue food.
It's if you're thinking of the barbecue as an event.
Yeah.
Right?
Potato salad makes or breaks the barbecue, I would say.
Yeah, that's a lot of pressure.
It is. If you don't get the potato salad right, your barbecue is crap.
That is true. What's your dish?
Well, everything. I'll throw a burger on there and light it up. Somebody can hand me a portobello mushroom. I'll grill that up for you. The grill master here, there is no bounds to what I will put on the grill and flame.
Except for potato salad.
Except for potato salad. Last week's landmark Supreme Court ruling striking down affirmative action will no doubt transform the world of college admissions forever. The decision fell along ideological lines, with 6-justice conservative supermajority invalidating admissions programs at Harvard and the University of North Carolina. Our next guest says the U.S. Supreme Court's decision to ban affirmative action in university admissions strikes at the heart of the American dream, the promise of substantive equality of opportunity. Joining us now, we've got Antara Halder, who is the Associate Professor of Empirical Legal Studies at the University of Cambridge. Thank you so much for taking the time here with us today. And as we were all kind of really looking in through what was the decision of last week and trying to, at the best we could, in real time decipher what it actually meant, from your own perspective, what type of precedent has this now set, and what kind of reversal is this?
Thanks so much for having me on the show, Brad. I feel really strongly about this topic, so it's really great to have a chance to chat with you about this. I think that the precedent that it sets is extremely negative, and I think that the ramifications of it are going to be very adverse for the American dream. In the legal academy, we talk about how a lot of society operates in the shadow of the law. The Supreme Court is the sort of conscience keeper of the nation and sets the rules by which many organizations, including critical ones that are sort of the custodians of the American dream, like Harvard or UNC, operate. And the precedent is going to make it very difficult for universities to put in place the kinds of diverse classrooms that have made the American university the incredible places that they are. The decision also risks having spillovers for corporate boardrooms and a whole range of, all the organizations in American life, really.
So, Antara, Diane here. I want to ask you, so when this decision came down, I know I probably shouldn't have been surprised by it, but I was. I reached out to several friends who were, just say Black friends who went to Harvard to ask for their thoughts. They were saddened by this news. We know that Harvard tried to maintain what it had put in place in terms of affirmative action. And sure, it may not have necessarily been a perfect recipe. At the same time, it is just one of the items that could counter years and different types of issues of systemic racism. So what does a university like Harvard or any other university need to do now in terms of putting in place some type of system to account for diversity, especially when you look at the data that is supportive of diversity, adding to the economy, to growth in the economy?
Yeah, absolutely. So like you, Diane, I was not, I was surprised by it, although I shouldn't have been. A lot of my colleagues were talking about the fact that they were expecting this ruling. I'm sort of hoping against hope that we wouldn't end up with it. I have spent the last 5 years partially at Harvard, and, I have a lot of incredible colleagues there, including, students and colleagues of color who are really deeply saddened by this. I think it's a real conundrum what admissions committees do now. My main appointment is at the University of Cambridge, and it's a law faculty that is over 500 years old, and we're not able to do at Cambridge what the top American schools have been able to do and were allowed to do in the light of affirmative action. And so it's, Harvard has just appointed an African-American president, and it's sort of, there are many ironies to this decision. The fact that it comes at the mark of the 15-year anniversary of the Obama election, the fact that it comes at this landmark moment for Harvard as a university. There's some work that admissions committees will be able to do through using sort of the socioeconomic status as a consideration in admissions, and there has been a reference in the ruling to the fact that college essays can refer to experiences of adversity, and that race can sort of show up there. But I think that with in the light of this ruling, it's going to have a chilling effect on admissions policies on diversity and of classes across the nation. We've seen this already in states like Michigan and California.
When we think about some of the Supreme Court decisions that have come down over the past year now, the Supreme Court has ruled on pro-choice. Supreme Court has had to deliver a ruling on affirmative action as well. When we think about these as economic implications that play out over a longer term period of time as well, is there kind of a larger kind of frame of mind, or at least way of thinking around how some of the decisions from a more politically or more ideologically type of moved Supreme Court is actually impacting the economy long term?
Yes, absolutely. I mean, diversity is in everyone's interest, and it's in the economy's interest. There's huge amounts of data to show this, and I think that what the Supreme Court is doing in making decisions in this that have this clear ideological slant is risking killing the golden goose in a certain sense. The very aspects of America that give it its unique vitality and unique sort of political and economic power stem from the fact that in less than 250 years of the existence of the country, and in less than really 40 years of affirmative action type policies being in place, that we've seen, the ascent of Obama, that we've seen more diversity in various sort of domains than we've seen in any other country. And the economic ramifications of this are going to be extremely negative. I mean, I think that that the court is letting down its own sort of jurisprudence. It's introducing a lot of uncertainty into the law, and it's doing a lot of harm to not only its jurisprudential legacy, but the economy.
Antara, I got to ask one other question. I want to read something one of my friends said to me, part of what he said to me. I can't think of one black person I know from Harvard who didn't have the horsepower to be there. Even the athletes were on point. And to paraphrase the rest, basically you essentially couldn't say the same thing about mainstream students there. White kids, to quote. So I gotta ask, does what has happened now severely handicap the chances for black students, or, there's the side that would argue that it didn't help anyway, and while still giving white kids a better chance now?
I think the thing to keep in mind about the affirmative action policy and why this ruling is so shocking is that the protection was so limited to begin with. You had to be a stellar candidate to even get in that application pile and be considered. And these were kids who had not necessarily gone to Phillips Exeter or Andover and did not have the sort of helicopter parents sort of putting them for a Harvard admission from the time that they were born. I mean, which was sort of Obama's story. It's been, my story. And everyone there was incredibly meritorious. It was just that tiny little edge that you got, as a result of the policy. So, and it's done, nothing but good. I mean, not just for the African American community, but for all minority communities. I'm the first person of color to be appointed, global person of color to be appointed to the faculty at Cambridge, and I can tell you that it's not pleasant or effective being the only person in the room. You need the diversity. So, I think we're going to need to mull on ways forward and on ways of keeping diversity alive. Harvard has made a statement that it is committed to doing that, but there's no point pretending that this isn't a really serious setback, and that it's going to make it difficult for admissions committees and corporate hiring and have serious economic spillover and really sort of impoverish the diversity that makes America great.
All right. Well, we will have to leave it there for now. Thank you so much for joining us today. Antara Halder, Associate Professor of Empirical Legal Studies at the University of Cambridge. We appreciate you.
Thank you so much for having me.
All your market action ahead. Stay tuned. You're watching Yahoo Finance.
Second half, companies I'm looking forward to covering the most. I would say it's cruise lines, honestly. I'll never go on a cruise, but I am excited for a lot of the fervor that has reinitiated, or for the companies that have been able to re-engage with a lot of the demand that has been pent up in the experience economy, and for cruise line operators that have been trying to bring people back on board, make them have a better vessel experience, and ultimately see a higher ticket or amount spent on those cruises. I think cruises have been off into the races, or off at sea, and doing quite well.
I don't know what mine would be. I mean, one of the interesting areas I think we'll continue to watch will be home builders, which have really gotten interesting here as we get into the second half of the year, because they have been responding to the lack of inventory on the existing home sales side by really ramping up their inventory. So the housing market, not just the home builders themselves, but what we see from housing overall, I think is going to continue to be interesting.
Welcome back. Shares of Tesla up slightly this morning as the market continues to digest the company's strong delivery numbers in the second quarter. A notable highlight, Tesla's Shanghai factory, where output is up 20% from the year prior. The site shipped a total of 93,680 vehicles in June. With more, we're joined by Yahoo Finance's own Pras Subramanian. Pras, help us dive further into some of these numbers here.
Yeah, we're seeing kind of like on the China level, the power of Giga Shanghai really coming through here. Like you mentioned, 94,000 vehicles in June alone. That's up 20% from a year ago. Really strong numbers there. Now, compared to last year, this is when they had some COVID shutdowns, some factory retooling. So we're seeing that. That's sort of why the lift is there. But nonetheless, that's almost 1 million unit run rate for the year just out of China alone. So that's huge. But looking big picture at Q2, again, strong numbers there, 466,000 deliveries last quarter globally, easily topping estimates there. And so what's powering results? It's the massive price cuts globally taking effect still. And you have that full EV tax rate for the Model 3 now in the U.S. that now came online in Q2, so that's helping out numbers a lot. Question is, will this continue?
That's
what
I wanted to ask you.
Yeah, and my thoughts are sort of products are getting a little bit older there, but Model 3 refresh is coming online supposedly in maybe the next month or two. We'll see. We've seen a lot of like test cars out there, new refreshed looks, so that should help. But Elon's playbook is usually just keep the same car out there, update the software, little tweaks here and there, but it might need a fuller or more broader refresh even for the Model Y, which is now I think one of the best-selling cars around the planet.
Do people buy used Tesla? Well, I'm sure people do buy used Teslas, but I'm not sure with the tax credits and how they work. Are they supportive of used Teslas as well?
Yeah, so there's a limited credit for used EVs. I think it's about half or less depending on your income and things like that, and the car's componentry. So there is definitely a support there for the used market. Now, those prices came down a lot when Tesla cut prices of the new Teslas. So you can get a really good deal on a used Model Y or Model 3 right now because of that.
What kind of deal are we talking? No, I'm just kidding. We'll talk offline about this. All right, Prod Supermanian, thank you so much. We appreciate you as usual. All right, a potential shakeup for the transportation industry. Trucking company Yellow warning they may soon run out of cash just 3 years after securing a $700 million federal bailout. In the face of Yellow's potential fall, who stands to benefit in the transportation space? Joining us now with his picks is Ken Hexter, BofA Securities Senior Transportation Analyst. So first, just explain to us where Yellow is with its problems.
Great, good morning. So Yellow's been at this for a while. They've been running out of cash. If you go back to 2008, 2009, during the great financial crisis, you had other carriers that were chasing their volumes. They went from about a 26% market share back then to a 9% share today. Over the last 2 years, they've lost about 30% of their volumes. In Teamster negotiations, which actually don't start till their contract doesn't run out till next April, they announced in negotiations that the Teamster said Yellow told them they were going to run out of cash in August. They came out with a lawsuit last week, and they said, actually, we're going to run out of cash in July. So the timetable seems to be moving up. It looks like the banks are not going to give them further loans unless they get some sort of Teamster agreement wrapped up earlier than the contract ends to give them some more leeway in work rules. And that's put a lot of pressure on them. And it seems that things are coming to a head a lot quicker than one would have anticipated. And that's going to cause continued volume fallout. And like I said, over the last 2 years alone, they've lost about 30% of their volumes.
Ken, I'm going to go a little bit more broad here. Where is the strongest portfolio play among transportation right now?
Well, you got to look at the cycle, right? Transport is a cycle. We don't make anything. We just move it in our world. So typically the truckload group starts first, then the rails, then the air freight because they're more concurrent with an economy, and then the less than truckload usually lags. And given that lag, you're seeing the volumes really come out of the industry. And given that pullout, that's what we're talking about with Yellow. If volumes start accelerating even beyond your fixed cost coverage, it can cause some of those volumes to leave a little quicker, and that can juice other carriers that have excess capacity and all of a sudden are able to take pricing up. So in a normal cycle, you'd normally start, if we're at the sort of the bottom, and when we're kind of bouncing along that, we've been bouncing along that since I'd say mid-February, when we kind of found a floor after the tight congestion from a year ago. And we've been kind of staying at this very low level. And we do a truck shipper survey every 2 weeks, and it really just shows us that we're kind of hanging around in that 40 to 50 range of our survey, which is a diffusion indicator, and that's kind of a historical lows. And so if you've been at that now for 38 weeks, 19 surveys, that's a pretty good freight recession definer in terms of how weak the backdrop is right now.
Okay, so that kind of goes into my next question, which was, is there anything within the logistics or even trucking business right now specifically that signals to you or flashes warning signs of Q3 2023 recession?
Yeah, well, we start off with defining a freight recession, right? And so when we look at how weak it is, the economics, we leave to our economists, right? Just because then you're talking about the services side, and services is such a big part of GDP overall. But from a freight recession period, just like we saw in 2012, 2015, 2019, we're seeing those same signs again of true fundamental weakness from a shipper point of view at this low period in the survey that defines kind of what a freight recession. Whether that turns into an economic recession, given rising interest rates, higher inflation, I leave that to the economists to make. They're still looking for growth, looks like through the end of the year, and I think they pushed out their recession call a little bit. But from a freight recession period, no doubt we're in the midst of one right now.
So Ken, I got to ask you. So Yellow has managed to avoid bankruptcy in the past, but let's say the bottom does fall out. Who picks up that market share?
So there are some customers as a unionized carrier. You'll have natural attrition of union shippers that have to go to another union carrier, which would be companies like ArcBest and TFI, which bought UPS Freight, renamed it T-Force Freight. So those two companies get some natural share. But the big ones are the non-union carriers, companies like Old Dominion, Saia, and FedEx Freight. Those three, over time, have figured out how to take capacity, take volumes, and create long-term value. So those are the three that we really focused on in our recent upgrades. But the industry benefits overall. There's no doubt when you lose a player that represents 9% of share, and if you look at the top, call it 10 LTL companies, less than truckload companies, they own, it's pretty consolidated, they own about 80% market share. So losing a 9% player in that, you're going to have immediate volume shift to the remaining carriers. And those like Old Dominion, Saia, FedEx Freight have figured out how to take that on very profitably over time and make investors money with that.
Ken Hexter, thank you for explaining LTL to me and others. All right, we appreciate you so much. BofA Securities Senior Transportation Analyst, Ken Hexter. Coming up, let's do a quick final look at the markets for this hour. We've got mixed market action. Stocks range bound as they wait for Fed minutes. We've got much more to come. Rochelle Okufo has you for the next hour of trading. Stay with Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks looking for some direction as we start the second half of 2023. We'll speak with one advisor predicting a multi-year boom for one economy, and it's not the US. Plus, a new era for COVID-19, how public health officials are handling this transition period and how prepared we are for another threat. We'll speak with the former White House COVID coordinator. Plus, the big tech battle escalates as Mark Zuckerberg gets set to launch Meta's Twitter-like app Threads. What this means for the state of social media, we'll discuss. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at a mixed picture here, we're seeing the A's and the FANG stocks weighing on the Dow there. The Dow off about 95 points or 1/3%. The S&P, they're also down, but ever so slightly, about 2 points there. We're seeing just a little bit there in the negative. And the tech-heavy Nasdaq there, as we mentioned, Amazon and Apple there, having a little bit of a pullback, but at least the Nasdaq still in positive territory, up about 1/10%. Let's also check in on the Treasury market as we await those details from the Fed minutes. We see the 5-year up about 0.2% there, the 10-year also up about 0.8%, and the 30-year up about 0.8% as well. Well, more bad news out of China sends stocks mixed. The world's second largest economy continues to falter in its second quarter, sending markets at home and in the US lower. Here to break this down for us is Yahoo Finance reporter Jared Blickery. Hey, Jared.
Well, hello, Rochelle. We got the numbers overnight, and it was a little bit of a disappointment on the services PMI front. That number came in with a 53 handle. The street was expecting a 56. However, 53 is still in expansionary territory, as is where it's been for several months. Now, the problem with the Chinese economy is they have not been able to fully reopen and stimulate demand. And so the People's Bank of China has been doing very targeted measures to try to restart the property sector, to try to reinflate the housing bubble. Although they don't want another bubble, they're not going to call it that. They need money to get into these sectors. And what's been happening is the yuan, and I'm going to show you that here, the yuan has been weakening. Now, a higher level here means the US dollar is strengthening and the Chinese yuan is weakening. And we can see year to date, the US dollar has gained 5%. And that has happened mostly over the last 6 weeks or so. Now, I want to show you some important levels here. Here's a 3-year chart. You can see we're now up against the levels. Those are the weak yuan levels that we saw from late 2022. But if we go to a max chart, you can see these are actually levels that haven't been in place since about 2000, let's say, call that 7, 2008, 2006, somewhere in there. So if the yuan were to weaken substantially further, it could kind of spiral out of control. And I think that's what some of the authorities are concerned about. So they haven't done a blanket devaluation just yet. But overnight and over the weekend, what they've done, the banks have lowered the rate that investors, I guess corporate investors, can receive on their American dollar deposits. In the U.S., we've got rates at 5%. In China, their rates are about 1.5%, 2%, depending on where you're going there. So there's a huge rate differential. And by taking some of that money out that people would otherwise be making, they're hoping that that invested money is going to fly out into the economy and into the hands of consumers and prop up the economy. That's the way the thinking goes. Is it happening? Well, not here. Here's what's happening today. This is a Nasdaq Golden Dragon China Index components, and we can see more red than green. However, over the last month, the Chinese government has been ramping up its efforts here. If we show this on an equal weighted basis, sorting by performance, we can see XPeng in the upper left, that's up 73%. But we can also see a lot of stocks still languishing in the red here. In fact, a number of these top line companies are in the auto sector, like Li Auto and NIO as well. Now, you compare this with a year to date, you're going to see a lot more red here. So many of these stocks have been underwater for several years now. Here's what the 2-year picture looks like. Only seeing 2 stocks there, Li Auto up 10%, another HOLI up 17%. Not even sure what that company is, but you get the picture here. There's a lot of underwaterness to overcome here. So the bottom line is the Chinese government probably going to keep stepping up, ratcheting up efforts to goose the economy without letting things kind of fly off the handle. And that comes down to controlling their currency. So far, they've been doing that somewhat, but there are concerns that the lid may come unhinged here. Rochelle.
Indeed, a lot of people were counting on that post-zero COVID rebound, still not seeing it play out as people would have hoped. A big thank you there to our very own Jared Blickery. Well, recovery in the world's second largest economy continues to falter. China's services growth softened in June. The Taishin Services Purchasing Managers Index fell to 53.9 from 57.1 in May. That's the weakest print since January. While it's still in expansionary territory, the drop shows that consumers are pulling back on spending. Well, as China tumbles, investors and businesses could be looking to other economies for growth. Our next guest says India could be the site of the next boom. Joining us now is Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Good to see you, Eddie. So talk about this dynamic here between what investors are perhaps either getting wrong about China or what they should be focusing on when it comes to India.
So right now, we think, because we believe that we are not out of the woods here domestically, and what way we've been managing our client portfolios is looking outside the U.S. And the reason why we think India is going to have a multi-year boom is because of some of the, not just geopolitical issues in China, but, you know, when you look at companies like Apple and Amazon, they're trying to broaden and diversify where their manufacturing is. And you're starting to see more investing in India. And I think that trend is just going to continue. So economically, China is getting weaker, as well as Europe is pretty much in a recession now. And you look at somewhere like India, where you're starting to see a tremendous amount of large companies, multinational companies invest there. They're probably going to be accelerating on their economy and growth, which is great for investors being able to get in there early. But when you look at the other major economies, you know, a lot of them are decelerating. So it's really just a pivot to not only diversify, but diversify in a place that we think it's the early innings of some expansion and lots of investing.
And Eddie, as we dig into the differences between how companies are investing in China versus India, we know when it was with China, it was first about the mass manufacturing, but also when it comes to AI and other things, some of this really fine knowledge that's needed, especially with manufacturing data. Is that the same sort of investments that you're seeing companies making in India?
Yes, and look, it's also kind of a play on technology, right? You know, AI obviously has been the hot buzzword, and this is a way to kind of, again, get some indirect exposure to that international and AI play in a country that is going to get a tremendous amount of investing in that space. So I think the trend of companies pulling out or investing less in China and looking to other areas is going to continue. I don't see a catalyst in the near term where you're going to see companies double down on investing into China's economy. Because again, there's some concerns with their government controls that they have on everything there as well, too, that provides a huge business risk for companies that don't diversify where they're going to be.
And so for people who aren't familiar with India's economy, obviously you have China's stock market, very different, sort of made up of some mostly retail investors. But when you look at the Indian market, how should people approach it? What should be on their checklist when they're trying to determine the best way in?
So for us, what we do for our clients is we just invest in ETFs that give us broad exposure to that economy. You know, and I think from an investor's perspective, that's probably the most prudent way to get exposure there. And again, you don't put all your eggs in one basket, as you know. We're still very defensively positioned with a very large money market position for clients, but we are increasing exposure to India, and we'll continue to buy dips if and when we get them in that space. But to us, the best calculated approach is to go into the ETFs that get you exposure to those economies.
And for people who want that balance of sort of looking at emerging economies, but also looking at the second half of the year for the US markets and the sectors that you like, what are the standouts for you?
So we really are very bullish on healthcare. We think there's going to be a tremendous amount. There is pent-up demand there. Look, a lot of families delayed getting certain types of testing during the COVID years, and now you're starting to see those folks getting caught up on these medical procedures that they've been waiting on. So we see a lot of demand there in the back half of this year. So we think healthcare, even if we go into a recession here domestically, has a good opportunity from an earnings growth perspective to deliver positive surprises to the upside. We also like aerospace and defense in regards to that area, and we're looking to be buying dips there. And then lastly, we are looking at energy. You know, energy has not had a great year. And with the decline in prices there, we're starting to see some attractive dividend yields. But we're just waiting because, again, the China slowdown and Europe slowdown does concern us and could put more pressure on oil. So from a domestically, healthcare is our number one place that we want to be buying dips for our clients right now.
Well, certainly good, as you say, to look beyond US shores, see what's out there, especially as you're bullish on India there. A big thank you to Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Thanks so much.
Thank you for having me.
All right, we're taking a look at one of today's trending tickers. I'm watching shares of Moderna, the stock surging today, up about 2.5% now. And that's on news that the vaccine maker made a deal to research, develop, and manufacture messenger RNA medicines in China. The drugs created there will be exclusively for China and will not be exported. Now, this comes after the company said in May that it was looking for opportunities in China and registered as a legal entity in the world's second largest economy. An unconfirmed report from Chinese media outlet IXIC said on Tuesday that Moderna was making its first investment in China that could be worth about $1 billion, citing unnamed sources. Now, the outlet also reporting that Moderna CEO Stéphane Bancel was visiting Shanghai. The deal comes as Moderna struggled year to date, the company forecasting a February impossible net loss for 2023 as demand for COVID vaccines has fallen. All right, we still have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What's the biggest risk for the second half of the year?
It's got to be the Fed. Fed Chair Jay Powell has already said that he's not going to rule out not just one more potential rate hike, but consecutive rate hikes that could potentially come in the second half.
Yeah, I think that's right. I think that we don't know when the hikes are coming. We don't know in what, how close together they might be coming, right? And then there's always some other risk that we don't anticipate, of course, but we don't know, we don't know that until it happens.
The housing sector has been in the spotlight with disruptions in home sales, home building and inventory due to a mix of macroeconomic conditions like inflation and, of course, tightening monetary policy. Fannie Mae, the government-sponsored housing organization, recently revised its housing call. Yahoo Finance's Danny Romero joins us with more on what's ahead for the housing market. Hey, Danny.
Hi there. Well, Rochelle, we've hit that halfway mark this year, and economists on the street, including Fannie Mae, are revising their forecasts. Fannie Mae, the agency, is forecasting that national home sales will drop about 1% this year and 2% next year. Now, why is this coming? What's going on here? Well, the reason is the tight housing supply, which is supporting those home prices to be elevated. And home building has ramped up tremendously this year. Home prices are proving to be resilient, outperforming expectations due to those baby boomers aging in place. The Gen Xers also locking in those low mortgage rates, and home building ramping up production and supply. Again, Fannie Mae isn't expecting home prices to crash, but more like to fall even further. We've seen some overheated markets like in the Western region. Those home prices are falling, while in the Midwest and in the Northeast, home prices are a little bit on the elevated side. Now, looking forward, looking ahead, Fannie Mae is forecasting that the 30-year fixed mortgage rate will hit, by the end of the year, will hit about 6%, and by next year, it'll be about 5%. Rochelle?
And so, Danny, keeping in mind that there are a few key events this week, you've got Fed minutes, jobs report looming as well. What's anticipated next then for mortgage rates for people who are looking?
So mortgage rates could go even higher given the key events this week. If we take a look at the 30-year fixed mortgage rate, it is about 7%. So it could go even up. Bond traders are anticipating, expecting volatility this week, which could push the 10-year Treasury yield to hit that 4%, as investors are really attracted to investing and buying government bonds. Why is this important? Well, the 10-year Treasury yield is the closest proxy to the 30-year fixed mortgage rate. So it's a good gauge on where mortgage rates could land, Rochelle.
All right, appreciate that update. Our very own Danny Romero there. Well, estate planning helps to manage a person's financial affairs and control the distribution of their wealth after their death. But how do you do that amid a volatile market, recession fears, and high inflation? Let's bring in Providence Financial Insurance Services President Anthony Saccaro to discuss how you can think about your retirement and your legacy planning. Thank you for joining us. So first of all, when we look at the main tenets of estate planning, what are the things that people should have in terms of what's on their checklist?
Rochelle, yeah, thank you for having me here. Certainly, the main checklist has to do with things to avoid probate after death and things to actually allow you to give other people the ability to control your financial affairs or your health affairs while you are alive. One of the biggest mistakes that we see people make is that they think that estate planning is only when you're gone. They don't realize that estate planning is also for the here and now. If you're a younger family, you need to prepare for your demise. What happens if something happens to you and you leave kids behind? Well, there's nomination of guardianship that you need to have in place to make sure that your kids are going to be taken care of by those whom you want to take care of them. So it's very, very critical to make sure that you have these documents in place. And it's not just for the rich, it's not just for the old, and it's not just for when you're dead. It's also for here and now as well.
And so when we're putting the pieces together, I mean, you have wills, trusts, probate, power of attorney, some advanced healthcare directives as well. How do you plan that when you do have so much uncertainty in the economy and you're trying to figure these things out?
Yeah, so I don't think we need to put too much emphasis on what's going on in the economy as to whether or not you should do estate planning. If the economy is good, you should do it. If the economy is bad, you should do it. If the economy is volatile, that really doesn't come into play when you look at estate planning or consider estate planning in general. You want to make sure that your estate plan is fully set up for you, regardless of where the economy is at. I think the bigger consideration as to whether you should have a will or whether you should have a trust is going to depend on a couple factors. The state that you're in some states, probate's really not that big of a deal. In California, where I'm at, probate's a huge deal. You want to do everything you can to avoid probate. So the state that you're in is a big deal, and the size of your assets. Each state has some type of statutory limit to where if you're under that limit, you don't even need a trust necessarily, because probate is going to be very simple. as well. So a lot of factors to consider state by state and the size of your estate.
And so when you think of how some of these stocks have had some really wild swings, if that's also part of the mix of things that you plan on passing on, how often should you update it, or is there sort of language or contingency plans that you should put in there in case there are wild swings up or down in some of the stock assets that you have?
Well, when we talk about the stock swings, there's a couple of ways that we can consider those. You can look at gifting plans, and if you're going to be gifting stock as part of your estate plan, when the stocks go down in value, that's a great time to gift because you can gift shares at a lower price so that when they do come back, those shares and the value of those shares are out of your estate. So that's one way to look at it. Another factor when considering gifting or when considering passing on capital appreciated assets, whether it's real estate or stocks, to your beneficiaries, is the estate tax threshold. Right now, the estate tax threshold is $12.9 million per person. So a lot of people aren't subject to that. But under the Trump tax rules that are going to revert back in 2026, those limits are going to go down to about the $6 million level. And so you want to make sure that you plan for the estate tax ramifications if your estate is over $6 million, even though right now the exemption is above that.
And when you look at the makeup of what people are planning on passing on, how much of it is, say, stocks versus, say, crypto versus real estate and other aspects?
Yeah, I think stocks and real estate are probably evenly combined. If you start to get into the upper echelons of wealth, people that are actually having to worry about that $12.9 million estate, that's mostly going to be real estate. And that's a great asset to pass on because you get what's called step-up appreciation as well, too, which means that if you have highly appreciated real estate and you pass that on to your beneficiaries and they sell that real estate, well, they inherit it at whatever the value is at the date of your death. So if they sell it immediately at that same value, they don't pay any tax at all, which is phenomenal. And that's also true with stocks. And that could be a reason why you might want to hold stocks as well, but to pass on when you're gone instead of giving them while you're alive. If you give real estate while you're alive, you give stock while you're alive, you pass on the basis to the beneficiaries, whereas if you wait till you're dead, you get that step up. So that's a phenomenal way to pass on assets as well, too.
And so then just to wrap up then, what are the biggest mistakes, say your 3 biggest mistakes that you see people making when it comes to estate planning, which could make them sort of lose out, especially the people who are benefiting from it, lose out on some of these benefits?
Yeah, first of all, the number one biggest mistake is not doing any at all. We deal with a lot of people that are in the older half of life, the second half of life, that has just never even done it. And these are people that have lots and lots of money, lots of assets. That's a big mistake. A second mistake is doing it once and then thinking that it's just something that is one and done, that you never have to do again. We recommend every 3 to 5 years reviewing it. And almost every time we review an estate plan for someone, there's changes that have to be made, even though they were only done a few years ago. And 3 to 5 years goes by just like that. So it's a mistake not to review it frequently. And the third mistake is younger people thinking that they don't need to do it. You still need durable power of attorneys, no matter what your net worth is, no matter what your age is, and you still need your advanced healthcare directives. That is absolutely huge. Your advanced healthcare directive allows you to choose someone to make your medical decisions for you when you can't. Because right now it's illegal for doctors or nurses or medical personnel to give information about you to anyone other than you. And if you have a car accident or a medical emergency, you could be stuck with the doctors making the decisions and not your loved one. So it's a big mistake that younger people haven't done this for themselves. And don't forget about your kids that are 18. They have to have these too, or you might not be able to get information about them. Huge.
Certainly important, and especially considering the size of the boomer generation that's going to be retiring or perhaps selling their businesses and thinking of how to pass these things on. Lots of great advice there. Thank you so much. Providence Financial Insurance Services President Anthony Saccaro, thank you for your time this morning.
Thank you, Rochelle.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
You're on a long road trip. What's the first album you put on?
First album. New Nation Project, Kirk Franklin. Gives me vibes, takes me back to when my family used to load up the car, go to Hilton Head, South Carolina. You'd hear Kirk Franklin's raspy, deep voice come on.
You want to give us a little?
I mean, dude, you want a revolution. Whoop, whoop. Like, that is the essence of beginning a car road trip right there. Take you back to the late 99s, early 2000s.
Mine feels a little lame compared to that.
No, you know.
I would put on Billy Joel's "A Stranger." Just like everyone, you sing along, you know the words.
Yeah.
That's a good one for me.
That's a good one.
Federal health officials have spent months preparing for a new era of COVID-19 as the battle with the disease that caused a global pandemic begins to regulate. Dr. Ashish Jha was key in orchestrating those plans, spending the last year as the White House's COVID-19 coordinator before stepping down to return to his position as the Dean of the Brown Law School of Public Health. Dr. Jha joins us now alongside Yahoo Finance's Anjali Kemlani. A big welcome to you both, and we, of course, thank you for all the work that you've done here. Please get us up to speed here on where we are now in the management of COVID and the longer term impacts of it as well.
Yeah, so good morning. First of all, thanks for having me here. We're obviously in a much better place with COVID, right? And part of it has been the work of the administration in making sure that people got vaccinated, that treatments became widely available. And the virus right now is in retreat. And so while it will be with us for probably forever, we now have the ability to manage this virus in a way that we did not 2-3 years ago. And that makes all the difference there is. We have plenty of vaccines, we have treatments, we have testing. We've put into place the kinds of things that allow us to manage this virus wherever it goes in the future. But certainly it is in a much, much better place right now.
Dr. Jha, thanks so much for joining us again. Tell me a little bit more about that in terms of how much of a threat is COVID to us, or what kind of way could we think of it as an ongoing threat to us here in the U.S., and also how to contextualize, the fall vaccines and the ongoing push there.
Yeah. So one of the things, that I think a lot of people have gotten into trouble with is predicting where COVID is going. This is a virus that continues to evolve. We've had an extraordinary 6-month period where infections have fallen dramatically. Mortality, deaths have fallen dramatically. We are at the lowest numbers, some of the lowest numbers of hospitalizations and deaths we've seen. And there is a temptation to say it's all over and we don't have to think about COVID anymore. The way I look at it is the virus can still surprise us. And so instead of spending a lot of time predicting what are the chances that we're going to get a new variant, what are the chances that it'll be disruptive again, what we need to have done is prepared. And that's what we really spent our time at the White House is making sure that if the virus makes a comeback, that we are fully ready for that with tests, treatments, vaccines, and all the tools that are absolutely necessary. One of the things that includes, Anjali, is the idea that people need to get vaccinated on a regular basis. For most Americans, that's probably once a year. That's what we're going to see with a fall vaccine campaign. It's not that different than what you do for the flu vaccine every year. For high-risk people, elderly, immunocompromised, it may be twice a year for a while until we have more durable vaccines. But right now, the idea of getting one shot a year and staying up to date on your vaccines and that really protecting you against serious illness feels like a pretty low burden and a very easy thing for people to do as a way to keep themselves healthy and safe.
One of the things I know that you had to deal with, and of course a lot of your peers, is the doubt in public health officials, and including this push for vaccines, but also the origins of COVID. I know we've recently gotten a peek at that intelligence community report. What can you tell us about what you sort of looked at your time in the White House, and what we should be thinking about in terms of how this came about?
Yeah. So on the issue of origins, it's really remarkable to me how certain people seem to feel about what we know. What the truth is, when you look at the data, you look at what is available, it is unclear whether this was a natural spillover or this was a lab leak or not. There's been a lot of efforts. The intelligence agencies, the president directed the intelligence agencies to do a comprehensive review, and the intelligence agencies did not come to a single firm conclusion just because there hasn't been the kind of transparency and openness that we really need here. So I think this is an open question, and I think this is one where we need a lot more transparency and openness from the Chinese government, and I think it just in general would be helpful to be much clearer on where the origins are. That said, the truth here is that there has been in the last 3.5 years an erosion in public health that we have to work on getting back. This is one of the things that has driven me to come back to Brown as dean of the public health school to help rebuild that trust. And some of that has been, obviously the public health community has done extraordinary work in the last 3.5 years, but they haven't gotten everything, right? And I think we need to own the places where we made mistakes, have honest and open conversations about how we do better. But also we've got to work on making sure that we're providing people with good information, because there's a lot of bad information out there that we have to counter as well.
I'd love to ask you to expand on that, because I feel like there's a lot that goes into that when it comes to social media, or there's some people asking, why should I bother getting an additional vaccine when I'm already protected largely against it? It doesn't seem like I need to, doesn't seem like anyone knows where this came from. There's a lot of doubt still, permeating through the US. And I just wonder, what are your thoughts and what are the tools available really to fight this?
Yeah, it's a great question. So here's how I think about this. Wherever it came from, the truth is the virus is around, it's continuing to infect people. Again, while infections are down, hospitalizations and deaths are down, they're still affecting. We're still getting probably tens of thousands of infections happening every day, hundreds of people ending up in the hospital, somewhere around 100 people dying every day from this virus. So still a real problem. And what I say to folks is the advice I give my family and friends. I have elderly parents. They get vaccinated twice a year in the last couple of years. I've been getting vaccinated annually. These are incredibly safe vaccines, and they're very effective vaccines. And again, if you think about it, one shot a year, the way you've been doing it for flu vaccines for years, it reduces your risk of infections, substantially reduces your risk of serious illness. It's a very low price to pay. These vaccines are largely free. So the cost benefit here is very clear in my mind for all Americans, but particularly for high-risk Americans, it's really important.
And Dr. Jha, unfortunately, COVID did become a political football. This was something that a lot of us hadn't experienced in our lifetime, having, a vaccine come to market this quickly. So when you combine that with also perhaps preparedness for where we are for the next pandemic or the next major health scare, how prepared would you say the US is?
Yeah. So the good news is we are clearly more prepared than we were 3.5 years ago. I think there's some effort to go back and say, oh, we're even worse off than we were 3.5 years ago. That is just not true. Over the last 3.5 years, particularly over the last 2.5 years under President Biden, we have built up a national wastewater surveillance system. We have restocked our strategic national stockpile. If you remember, we had no masks, no gloves, no gowns in our strategic national stockpile. Those have all gotten repleted. We have taken the lessons of Operation Warp Speed, which I think was an enormous success under President Trump, and we have built on that by launching a new thing called Project NextGen, which will build a newer generation of vaccines. So we're in much better shape, not as ready as we need to be. There's still important work to do, but the bottom line is we're in better shape. And I think the truth is we have to bring down the political rhetoric on this virus. It is a virus that has killed over 1 million Americans. It has killed Democrats and Republicans, liberals and conservatives. It has killed Americans, of course, it's killed people around the world. Turning down the heat on the rhetoric and focusing on protecting Americans, that should be the goal for all people.
Dr. John, final question for you here on the outlook for really public health. I know that we had, the fires, the wildfires from Canada, the haze that descended upon New York. And I just wonder, what do you plan to focus on now that you're back at Brown?
Yeah, actually, there are some enormous challenges facing our country and facing the world. I mean, for the first time in a century, we have seen a decline in life expectancy. Other high-income countries have started recovering. The United States has not. What that means is people are dying younger. They're dying unnecessarily. There's opioids. There's gun violence. Climate change represents one of the biggest threats. Of course, we're seeing that manifest itself. So there are enormous challenges in front of us. I think our School of Public Health, Brown School of Public Health, is uniquely poised to tackle some of that. But my goal over the next few years is to make sure that we're taking those issues head on, making progress on them, because that's how you protect people. That's how you protect lives. That's how you make sure that America and the world continues to be healthier as the years go on.
I know you'll still have your hands full even post-COVID. We do appreciate you taking the time to join us this morning. Dr. Ashish Jha, Dean of the Brown School of Public Health and a former White House COVID coordinator, along with Yahoo Finance's Anjali Kamlani. Thank you to you both.
Thank you.
All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
I mean, I'm a burger girl. I like burgers, right? A very simple burger on the grill is a joy, right? Corn on the cob on the grill.
Yeah.
I also like potato salad, which is not for everyone.
Throwing that on the grill?
No, but I do like potato salad.
It's a grill annexed type of
Yeah, it's a barbecue food.
It's a barbecue food.
It's if you're thinking of the barbecue as an event.
Yeah.
Right?
Potato salad makes or breaks the barbecue, I would say.
Yeah, that's a lot of pressure.
It is. If you don't get the potato salad right, your barbecue is crap.
That is true. What's your dish?
Well, everything. I'll throw a burger on there and light it up. Somebody can hand me a portobello mushroom. I'll grill that up for you. The grill master here, there is no bounds to what I will put on the grill and flame.
Except for potato salad.
Except for potato salad.
Mark Zuckerberg looks to be entering the ring with Elon Musk once again. Meta announced new plans to roll out a new microblogging platform called Threads, which could directly compete with Twitter. Joining us now is Ali Garfinkel to tell us more about the latest showdown. They do seem to be going at it these days, Ali.
They do seem to be going at it, Rochelle. And I have to tell you, this particular blow had the element of surprise. Of course, it has been rumored for some time that Meta would be launching a competitor to Twitter. However, I certainly wasn't expecting it to show up in the dead of 4th of July weekend unceremoniously in Apple's App Store. Now, this is developing fast, but there are a couple of key things we do know. The first is that the app will be called Threads, and it is set to launch tomorrow, July 6th. Now, it is connected to Instagram. And to me, this is actually the most salient point, the most key thing that you need to know. It's important because the goal will be to leverage Instagram's 2 billion plus users. Now, that's a lot of users. And frankly, compare it to, say, Twitter, which we don't have official numbers, but is between 350 and 450 million number of users. So the thing to consider here is this. All social media businesses are advertising businesses. Meta linking Threads to Instagram means that it is going to look to advertise to all 2 billion people it has on Instagram. Now, the bigger the population, the more advertising capabilities, the higher the ceiling. Though we're seeing Musk and Zuckerberg possibly set up to throw punches in person at some point, I will say that to me, the thing that is most salient here is they're going to be trying to notch some wins with advertisers. And that, I think, is where the real difference is going to be made, Rochelle.
I mean, so I know we talked about that matchup with them in the cage match potentially, but what about in this app space? Does Meta's app have a chance against Twitter?
I'm going on the record saying that I do believe a cage match between the two of them is the sign of the end times. That said, in this particular case, I actually do think Meta has a chance here, but I think wondering if they do is also the right question. We've seen a number of Twitter competitors try to make their mark and fail, right? You've seen Blue Sky, you've seen Mastodon, you could even count Truth Social in that category. But Meta has this giant user base, right, Rochelle? And I think there is something to be said for the fact the combination of that user base creating a sort of incumbency advantage and the fact that Twitter, frankly, is vulnerable right now, regardless of what they say. There are statistics that show that since the acquisition, more than 30 million people have left the platform. And recent Pew research showed that 25% of the company's most active users are no longer posting as much. So it's the sort of thing that while I think there is definitely an opportunity here for Meta, cage matches aside, I do also think that in this particular case, it will be a new app for Meta, regardless of the connection to Instagram. So it is still incumbent on them to land those punches and get things right.
We'll certainly be following those ad dollars and see where they land. Thank you for getting us up to speed. Our very own Ali Garfinkel. Good to see you. Well, speaking of spending, consumer spending nudged up by 0.1% in May, which was below consensus. But our next guest believes the consumer may have lost some momentum, but there's some strong growth underpinning future spending. Wages and salaries are up 0.5%, and that's the most since May, and personal incomes were up 0.4% in May. Let's bring in BMO senior economist Jennifer Lee to discuss this more. Hello, Jennifer. I mean, we kept hearing, at some point the consumer's going to pull back sharply. Haven't seen it yet, though. How would you characterize the state of the consumer right now?
Well, hi, good morning. Thanks for having me on. And by the way, I'm still picturing that cage match that you guys were just talking about. Overall, we have been continuing to wait for that U.S. consumer to pull back. But that saying about how you should never underestimate the American consumer still holds very strongly. They may be taking a little bit of a breather right now, but as you just pointed out, there is still a lot of strong underpinning beneath the consumer, and that's because of still steady wage growth. Because at the end of the day, it's for the U.S. consumer, it's all about having a job, having a steady income. You don't have to be spending every single penny every single month, which is probably a good thing. And you should probably be squirreling a little bit away for a rainy day. And that's what's going to help support future consumer spending. Again, you don't have to be spending every single cent right away. But as long as they've got some strong financial backing behind them, I think that bodes well for the overall consumer and for the economy as a whole.
And do we get a sense of how many are actually putting this money into savings while they're actually also sort of taking on more credit card debt and other consumer debt as well, in really trying to figure out what comes next for the consumer?
I think, again, it's just like as long as, I'm going to sound like a broken record here, but as long as that labor market remains still tight, not as tight as it once was. I think most consumers, broadly speaking, are still saving. You saw that in the latest May personal income and spending numbers, where you saw the savings rate tick up a little bit by a couple of percentage points. But of course, at the same time, you're just still taking on. Everyone has credit card debt, or almost everyone has credit card debt. But again, because they're still saving some money away, putting some away, it supports future spending. And that's, again, at the end of the day, is what really matters.
And of course, we'll not only be hearing from the Fed, getting some of those FOMC minutes, but also, of course, we're going to be getting the jobs report coming up at the end of the week. What are the expectations there?
So we are still looking for roughly 200,000 jobs, which is still in any given month a very strong figure. We're not going to see 500,000 gains anymore. That's definitely a thing of the past. But again, 200,000 jobs, roughly, jobless rate to be roughly similar to about 3.7%, which is well off the lows, but still very, very low, and still steady earnings growth, about 0.3 in the month, which is about a little bit over 4% year over year, which again, still strong. And this is it's almost like a Goldilocks scenario, where you don't want it to be too hot, but you don't want it to be too weak either. You just want it to be just right to sort of keep the Fed maybe not always on pause, because we are looking for that rate hike coming in at the next meeting. But at the same time, we don't want it to be too strong for the Fed to start talking more hawkishly than it already is.
And especially when you look at action from the ECB, I mean, we're still getting that same hawkish message, it's not done yet, we still have more work to do. How does that factor into what happens with the consumer in the US, and perhaps with the Fed keeping an eye on what's happening with those other central banks?
I think that definitely impacts the spending, the plans for spending, the psyche, I guess, for all consumers. And this is not just for American consumers, but for consumers everywhere. Central bankers do not have to be constantly raising rates at every single meeting. Obviously we're seeing these pauses that are taking place, like in the US, in Canada, in the RBA, for example. But as long as they continue to speak hawkishly and warn that our job is not done, we will not rest until inflation is back to 2%. That will certainly help make consumers, I think, sort of think twice before they start spending more. And again, it's contributing to putting a little bit of money aside for a rainy day, because rates will continue to go higher, and they will stay high for some time before we start seeing them being pulled back. We look for more rate hikes in all the major central banks, but we don't look for rate cuts to start kicking in until probably sometime in 2024.
And hopefully consumers squirreling away some money then in preparation of that. A big thank you to BMO senior economist Jennifer Lee. Thank you for your time this morning. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What's the first thing you drink in the morning?
Water.
Water? Really?
Of course.
I sit right next to you. I never see you drink this water.
I drink it at home. I drink it on my way into the office.
Okay.
Drink water. That's
Fair enough.
the first thing.
Those are two environments that I'm also not in.
Coffee's later.
That's fair. Coffee is my first thing that I think I drink in the morning, but I don't do like some of the other unnamed people on our team and go to Starbucks and get a $9 drink, or to any of the national chains. Support your local businesses if you're getting that cup of coffee in the morning. I kind of hyper-oscillate between two that are in equidistant areas of this office.
I just love that you put in this question as a reason to criticize the people on our team who buy
I'm just trying to encourage
chains
spending, buy local, everyone.
Buy local, or just turn on your tap.
It's a holiday shortened week, but from key data on the docket to certain stocks continuing to break records, there's still lots to talk about. Let's get to Jill Malandrino at the Nasdaq. Hey, Jill.
Hey, Rochelle. Electric car sales are breaking new records with momentum expected to continue through 2023 with demand surging worldwide. The International Energy Agency believes that sales of battery-powered vehicles are set to break records once again, leading to a historic transformation in the auto industry that could eventually challenge the dominance of internal combustion engines. Requesting by 2030, replacing pumps with plugs is set to avoid the use of at least 5 million barrels of oil a day. The overwhelming majority of electric car sales to date are concentrated in China, the United States, and Europe, although sales are beginning to flourish in emerging economies as well. Electric car sales more than tripled in India and Indonesia last year and more than doubled in Thailand. In emerging markets, 2- and 3-wheeled EVs outsell their 4-wheeled counterparts, offering affordable and sustainable mobility, and cars, bikes, and light vehicles are just the start. With heavier EVs, such as buses and trucks, expected to become more commonplace in the future. In fact, Amazon just announced on Monday that it has begun rolling out its custom electric delivery vans from Rivian in Europe. This will be Rivian's first commercial shipment of vans outside the United States. The IEA currently expects to see 14 million in sales by the end of 2023, representing a 35% year-on-year increase, with new purchases accelerating in the second half of this year. As a result, electric cars could account for 18% of total car sales across the full calendar year.
Now, Jill, we know that Tesla stock has been really going gangbusters of late, but what's the outlook for the industry at large?
Auto stocks have traded very well thanks to the bullish EV production figures reported by U.S. and Chinese OEMs, although investors should keep their enthusiasm in check until the margins associated with these volumes are known. For Tesla, that will come on July 19th when the company reports Q2 earnings. Here's part of the challenge as it relates to earnings. In April, the Environmental Protection Agency proposed a rule intended to significantly curtail carbon emissions. If adopted, it would require that electric vehicles make up 60% of all new vehicles sold by 2030 and 67% by 2032. It was a significant escalation from the Biden administration's previous goal of 50% electric vehicles by 2030. Now, Tesla's 4% plus better than expected 2Q deliveries in combination with global pricing trends, which appear to have roughly stabilized since declining sharply in the first quarter, paint a bit better picture of demand for Tesla vehicles than was the case at the time of first quarter earnings in April. And as such, JP Morgan modestly increased earnings estimates, even though they rate the stock underweight. Analysts are concerned about valuation. And although both technology and execution risk seem substantially less than was once feared, JP Morgan believes that expansion into higher volume segments with lower price points seems fraught with greater risk relative to demand, execution, and competitions. Now, risks to that thesis include the demand for Tesla vehicles could rise materially, gasoline prices could increase, we know OPEC's doing cuts, or government penalties and regulations on rival internal combustion engine vehicles could increase as well, which could drive adoption toward electric vehicles benefiting Tesla. And finally, better than expected execution on operating targets. That's the risk to that underweight thesis.
All right, we do appreciate that update, Jill Malandrino, there for us at the Nasdaq. Thanks so much. All right, well, before we go, let's get you a final check of the market action as we head into the noon hour. It was a mixed picture earlier. Now it's red across the board as the Nasdaq turned negative. The Dow now up about 76 points, still though well off its session lows so far this morning. The S&P 500 also still down about 5 points there, ever so slightly, about 0.15% there. Tech-heavy Nasdaq there, as we mentioned there, turned negative, now down about 20 points. Seeing some of the FANG stocks there, the AAs and the FANG stock, Amazon and Apple, still under some pressure this morning as we await more details from the Fed minutes as well. And of course, drawing a collective breath ahead of jobs data coming out this week. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.